Okay, good morning. Are there any administrative matters before we begin with this panel?
Yes, good morning, Chair Gillette, Commissioners. Just one, yesterday the company took a number of supplements to late filed exhibits and discovery responses. I'd like to request that the date for those be extended to 5/29 in light of the number of supplements that we have and the fact that the people that have to work on those are in the hearing room with us until we conclude. So that would be a request to keep the record open for 2 additional business days to the 29th to enable the company to provide those supplements.
Any objections?
Not from the OCC.
Okay, thank you. Then I will hold the record open purely for the supplements. And this isn't so much a caution to you, but to parties and interveners generally, that is not an invitation to supplement the record with anything other than the requested supplements.
Understood. And we appreciate that. Thank you.
Thank you. 4 p.m. on 5/29 would be
Sure.
great.
Thank you.
Thanks. Okay, anything further?
No, otherwise we have our clean energy panel ready to go. Everyone has been previously sworn, so we just have to adopt their late filed exhibits.
Very good. And if we can do that, and then we will begin with cross, please.
Sure. I'm going to direct these questions to Ms. Brown and Mr. Romero. Did each of you, as part of your preparation for this late filed exhibit hearing, sponsor or co-sponsor responses to late filed exhibit requests issued during the course of the hearing?
Yes.
And do you have any corrections or clarifications to any of your late filed exhibits?
No.
And do you adopt your late filed exhibits as part of your sworn testimony in this docket?
Yes.
Yes.
Thank you. The witnesses are available for cross-examination.
Thank you. We will begin cross with the Office of Consumer Counsel, Attorney Wheel, please.
Thank you. Good morning, Tom Wheel from the Office of Consumer Counsel. My first question is on late file 108, attachment 1. I'm looking at the redacted public version.
Yep, ready.
Thanks. So this is the quote the company received for the advanced leak detection program in New York. Is that correct?
In Connecticut.
Okay. Yeah, I was going to ask. So this was a quote for CNG for the advanced leak detection pilot.
Correct. For advanced leak detection pilot.
Okay. And there's the first line item here that says Surveyor 2.0 ethane enterprise. Do you know what that is?
That's their hold on one second. Pull up the unredacted version real quick.
Sure. Yeah, and I have no questions about the numbers that are redacted on the public version.
That's their program suite, I guess you would say. Their proprietary data software.
Okay. And that has a net price of $0. Do you know why that is?
I do not. I think that's just specifying the system that they would be using.
Okay. And then the next line item is Surveyor on-site services. And that's the full amount of the quote, right?
Correct.
And as I recall from the hearing, it was my understanding that this program is paying a third party like for that part of this cost includes like the third party vehicle costs and hardware. Is that correct?
Yeah, it's all inclusive of their personnel, vehicle, which is part of their program already, and all the equipment associated to it.
Okay. Did the company ever get a further breakdown showing all those breakouts?
No, we did not request that.
Okay. So was this quote the only basis for this is the only documentation for that quote?
Correct. It's based on, the mileage and the list price per miles and so on and so forth.
Okay. But did the company ever see the price per mile or the anticipated mileage?
We provided the anticipated mileage and it's part of the redacted numbers there.
Okay. Okay, so that would be the quantity and the price.
Correct, for that subset.
Okay. And was this competitively, did the company seek quotes from more than one vendor for this?
Um, there aren't many vendors who have this technology or capability. I know that as of recent, there are newer companies are available to us. If we were to proceed, we would be looking at a full RFP out there. This wouldn't be just based on this singular quote.
Thank you. Yeah, I remember that. I remember the panel testified for that during the hearing. And this quote, it says it expired in October of 2023, right?
Correct, that's when we requested it.
Okay, so there wasn't a more recent request.
We haven't gone, like, again, pending this, rate case, we haven't gone to an RFP and requested it.
Okay. And the revenue requirement request for this pilot is $445,400. Is that accurate?
I'm
getting that from the,
Yeah, I believe so.
okay.
That was the original testimony.
Yeah, that's the number on page 11 of the testimony. So subject to check, does that sound right?
That sounds about right.
Okay. And obviously this quote is for slightly less than that, not a material amount, but do you know why the rationale for the differential there?
I could not speak to that at this moment. If anything, it was associated to the number of personnel, or if we modified mileage, I'm not quite sure exactly where that variation would be. It could also be during the concept, the increase in expected rate to go up from 2023 to 2025, but I don't have a definitive answer for that.
Okay. Thank you. I'm going to move on to LFE 109. Just a second.
Attachment or the,
I think it's the attachment. I'm having trouble opening it on my own machine here. It is the attachment that I'm going to ask about. Just a second, I apologize. This clicking is the sound of me going through a very large docket. Yeah, so the redacted attachment. So this, the total quote here is for $307,098.01, right?
that is correct.
And just looking at the line items under the description, it looks like that's inclusive of the primary unit for about 190,000, a 1-year warranty for about 15,000, parts and accessories for about 68,000, and a training course for 12,000, and then tax. Am I understanding those line items correctly?
Correct.
And I saw in the narrative response to LFE 108 that the company also has to purchase hoses, valves, and connections. So is that the difference between this 307,000 number and the revenue requirement proposal of 325,000?
I believe so.
Okay, so it's about 18,000 for that additional equipment.
17,000 something. Yeah, thereabouts. Yep.
Okay. And the original testimony on page 9 discusses an estimate for an ongoing $4,000 annually in O&M for maintenance and inspection.
Correct. That's of the equipment and trailer.
Okay, would that be performed by the vendor?
The estimate was from an internal resource, so from our own fleet group. But I'm not quite sure if that came from or originated from expectations of what the vendor requested.
Okay. But would that, the estimate came internally, but would the estimated, who would be performing the maintenance work?
I believe it's our internal fleet,
Okay,
but that'd be subject to, I have to check on that.
thank you. And this quote I didn't see, was this prepared for CNG or for NICEAG?
This was prepared by our fleet for our CNG.
Okay,
Our fleet person happens to be out of New York.
and same question as before, were there more than one, did the company seek more than one quote for this coming from different sources?
Similar to the AMLD, this is newer technology. I don't believe we've gone to a full RFP with this. We'd be looking, for similar capabilities and then putting it out as an RFP.
Okay. Thank you. I just have a couple more questions about late file 110. Which is about the royalties received by the New York affiliate for memberships. Well, for the work developed via the memberships in GTI and NYSERG. Just want to make sure it's in front of the panel.
I got it. Yes.
Okay, thank you. Does the company expect that membership in GTI and NYSERG for CNG could or would also result in royalty revenues?
Would expect so, yes.
Okay. And how does the company, do you know how the company treats that royalty revenue in New York? In other words, does it credit it back to customers, or is there some sort of rate making treatment for
I
it?
believe in New York, they use those royalties to reinvest into the R&D program. In Connecticut, we would be looking to use that as an offset to the program costs.
Okay. So would that take the form of, like in future rate cases, the going forward revenue requirement for the membership cost would be reduced by the expected royalties?
Correct.
Okay. But there's no offset in this request for the expected royalties?
Not at this moment.
Okay. Do you know how long in the New York affiliates was there? I recall from, I think, the earlier panel that the New York affiliates have been members of these organizations for a long time. Is that correct?
That's correct.
Do you know whether there was sort of a gap between when membership was initiated and when royalties started being generated?
I don't know that specifically, but I expect there would be.
Okay. And the royalties, are those associated? I mean, I understand those are the R&D that's developed via NYSERG and GTI, I guess on behalf of the company, that information is shared outward and that's what generates the royalties.
Right. GTI would essentially turn that over to a commercializer who would commercialize the intellectual property.
Okay. So are the royalties like, I guess I'm trying to get a sense of, is this like does every member get a portion of the overall royalty revenue that comes into the organizations, or is it like specifically the royalties that are earned on intellectual property that's specifically developed on behalf of a specific company?
Yeah, it depends on the percentage of investment that the company would make in a particular project. So if there was a project that we didn't invest in, we wouldn't get any royalties. But if we were heavily invested, we would get a higher percentage of the royalties than other companies.
Okay. Thank you. I think that was my last question for this panel. Thank you.
Thank you. Peer staff, no cross. Attorney Wright. Thank you. EOE. Commissioner Karen.
No questions.
Questions, does the company need a moment to consider redirect?
Yes, just a moment.
Okay.
Thanks. All right, we have just one question on redirect. Mr. Langland, you recall the question from Attorney Wheel relating to the topic of royalties.
Yes.
Is it a certainty that royalties will result from any of these initiatives?
It's not. I think with, R&D, it's just by its nature, some projects work out, some don't. So we can't necessarily anticipate royalties as a result.
But if they were to result, your testimony was that they'd be used as an offset to program costs, correct?
That's correct.
Okay, thank you. That's all we have.
Thank you. Can we transition into the SCG version of this panel and turn it back to you, Attorney Venora?
All right, thank you. To the panel, do you all recall answering a series of questions that I asked you at the start of your testimony for CNG on this topic?
Yes.
Yes.
Yes. And do you also recall answering questions on cross-examination from the OCC during that portion of the hearing?
Yes.
And in appearing now for SCG and for purposes of administrative efficiency, do you adopt your testimony from the CNG transcript and stipulate that if asked those same questions again, your answers would be the same?
Yes.
Thank you. The panel is available for cross.
Thank you, Attorney Wheel.
Thank you. For the record, Tom Wheel again from the Office of Consumer Counsel. Starting with LFE 115, which is the SCG equivalent of the late file for the advanced leak detection quote. Looking at the attachment, I noticed that there's a different bottom line here, a slightly different overall cost. And I see in the footer that says Southern Connecticut Natural Gas. So this is a quote specific to SCG.
Correct.
Okay. And is the driver behind that difference just the different mileage estimate?
Correct.
Okay. And other than those differences, would all of the questions that I asked you about this quote with respect to CNG be the same for SCG?
They would be.
Thank you. Well, and I guess I sort of asked this question to CNG also, but just to confirm, there's similarly a relatively immaterial difference between this quote and the revenue requirement request, which on page 11 of the original SCG testimony was $504,600, so exactly $2,000 more. Do you know is it the same response for
It
the
would be
reason
the
for that
same. I
difference?
believe it's the same response.
Okay, thank you. I'll move on to LFE 116, which is the SCG equivalent of LFE 109 pertaining to the gas recapture pilot. So the narrative response, are you there?
Yes, I'm there.
Okay. So the narrative response to this actually references back to LFE 109 CNG attachment 1. So I assume that means that it's the identical quote.
Correct.
Okay. And I had asked you during the CNG panel whether that quote was for CNG. Was the vendor asked for a quote differentiating between the companies, or is SCG just assuming it would be the same?
It's the exact same equipment, so the quote came in to CNG, but it's the exact same equipment for both companies.
Okay. So other than that, would there be any other differences between in your responses to the questions I asked during the CNG panel as to SCG?
They would all be the same.
Okay, thank you. And lastly, I guess back to LFE 10, which was a CNG response, with the same, I guess I'll say SCG is also requesting the same, well, similar membership expense in the same organizations, right?
That's correct.
So I think would the responses to the questions I asked with respect to CNG about the potential for royalties, including your redirect testimony, be any different for SCG?
It would not. It would be the same.
Okay. I did have one follow-up, and this is sort of a rate-making question, so I'm not sure whether I'll just ask the question. So my understanding of the forward-looking plan for royalties in the event that the company receives any, with the understanding from your redirect that it's not a certainty. My understanding is that the treatment for that would be an offset to the expense, to the membership expense. And I'm a little confused how that's going to work if, given the redirect testimony, the company can't know whether and to what extent royalties will come in the future. From a rate-making perspective, if it's an offset to a prospective expense being set for a future rate year, I'm not sure mechanically how that proposal is going to work. Can you explain that?
Well, I think we have somebody who has a shot at explaining that. So we have Mr. Hurwitz, who's previously sworn, who can address your question, Attorney Wheel.
So I think as Mr. Langland described, it's not a certainty that we'll earn royalties. Currently, our plan is to invest the amount that we've indicated in our initial filing, and when and if we receive royalties, we determine whether, we want to invest more in the program, whether, at that point, we might be in the midst of another base distribution rate case. I think that's a point in the future which we haven't made an official and final determination with at this point in time.
Okay, fair enough. So the idea then is that, I guess like the basis for my question and for the late file was that I think the company's assertion during the initial hearing that one of the benefits of these investments is the incoming royalty revenue. So is it fair to say that that's a future benefit that would be addressed in a future rate case?
I think so, and that benefit could manifest itself in a number of ways, including additional investment in this program, lower cost of ratepayers, or some other scenario at that point in time.
Thank you. And that was OCC's last question for this panel. Thank you for your time.
Thank you. Authority staff. Attorney Wright. EOE. No questions. Do you need a moment to consider redirect?
No, we're all set, I think, in terms of redirect. We have two witnesses, though. I just wanted to clarify before we release them for the day that other cross-examiners may not need them on other panels, which would be Ms. Brown and Mr. Lavulo, I'm sorry, who answered questions on ESG-related topics and supplier diversity. So we have them here on this panel. I think there was a potential overlap on others, but I just wanted clarity before we release them.
Yeah, I appreciate the flag. I think the potential overlap is on the comp and benefits panel, which is next. I know that I have a question. In reviewing the transcript, I had been pointed to the comp and benefits panel for two things on KPIs. Sorry, looking at my notes. LFE 122, I think, and KPIs about gas operations. I think I've been pointed to the comp and benefits panel maybe by these witnesses or an earlier panel. So to the extent that they need to assist with those answers, I think we could definitely release them after the comp and benefits
Okay.
panel.
Okay, that's helpful. Thank you.
Okay. I can survey others if that's helpful.
No, that's fine. As long as we, if there's a potential that your questions would overlap in their area, then,
Okay.
and I don't think the comp and benefit cross is scheduled to be very long today either. So,
No, and it's right next.
Yeah,
So,
right.
okay. Appreciate that. Okay, so let's transition into the comp and benefits panel first for CNG. And I do believe OCC is up first for that.
Okay, as the panel's getting situated, all of the members of our panel have been previously sworn. So I just have preliminary questions. And also, Ms. Van Luling and Mr. Hurwitz have previously adopted all of their late filed exhibits. So
Okay.
these questions will be addressed to Mr. Visconti and Mr. O'Neill, having been the sponsors of the late filed exhibits on comp and benefits. So Mr. Visconti and Mr. O'Neill, as part of your preparation for the late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of the hearing in this docket?
I did.
Yes.
And do you have any corrections or changes to any of your late filed exhibit responses not previously identified in a response to a late filed exhibit?
I do not.
And do you adopt those materials as part of your sworn testimony in this docket?
I do.
Yes.
Thank you. The panel is available for cross-examination.
Thank you. Attorney Wheel.
Thank you. Good morning. Tom Wheel from Office of Consumer Counsel. I have questions about LFE 10 attachment 1.
We're here.
Thank you. So this is the total incentives paid on a per employee basis in both 2022 and 2023. Is that correct?
That's correct.
I think we went over this a little on the revenue requirements panel, but these are the incentives that were earned in the prior year and paid in the years that are shown here.
That's correct.
Thank you. So, and I had asked during the revenue requirements panel, but just to confirm the incentive plan column where it says APA versus union, if I separate out if I sorted this sheet by those, then I'd be able to see the distinction between the incentives paid to union versus non-union employees.
That's correct.
Thank you. So I did that for the 2022 year, and I got for non-union employees, the total paid in the year was $727,572. Is that accurate?
For non-union. $727,572.
Yes.
Yes.
And that's to 71 different employees.
That is 71 employees, correct.
Thanks. And the union total then would be 13,681 and 17 cents.
The union total is $13,681.17.
Thanks. And that's to 27 different employees, right?
Correct. That's for 27 employees.
Okay. So if I divide those totals by the number of employees, that gives me the average incentive comp paid on a per employee basis.
Yes, that's how I would calculate the average.
Okay. So the difference then, if you do that, non-union employees on a per employee basis earned $10,247.50, whereas union employees earned only $506.71.
Yeah, it's subject to check your math. Yes, sounds about right.
Thank you. And then on the next tab for 2023, the total, sorry, to go back, and I think we already asked you this, Ms. Van Luling, but the just for the record for this panel, in the same exhibit, the LTIP that's reflected at the long-term that's reflected on these two exhibits, that's not in the revenue requirement, is that correct?
Correct. The LTIP as reflected in these two exhibits is not included in the revenue requirements.
Thank you. And for 2023, I did the same sorting and same exercise. And just for the non-unit employees, I got 821,813 total.
$821, $813?
Yes.
Yes.
But I noticed that that's, at least from my Excel count, which I'm sure is the same as yours, was for only 60 different non-unit employees, which is a reduction in from the 71 of the prior year.
Yep.
Okay,
And I think we saw the corresponding increase. There was an increase to ASC that was charging that we chatted about yesterday. I think it was you and I, or it might have been me and Mr. Ferrante.
Beluski, or
Okay.
perhaps.
Just to clarify as well, in terms of, there's a price v volume part of this, so the volume being the participants, but there's also a price part, and that price part is driven by, well, these incentives are driven by 4 factors. So the number of employees, merit increases, or any other increases that's been applied in that year, which affects the following year, the achievement, which is driving this higher. And then on an actuals basis, any prior year true-ups, and that's reflected from an accrual versus the actual. So there are different factors, but the achievement factors are increasing. So if the price is going up, that's what's driving the price increase.
Thank you. That was going to be my question, is just that from what I could tell on a per employee basis, for non-union employees, there's an increase of, well, but from the $10,247.50 last year to $13,696.88, which is a 33.66% increase. So the reason for that would be well,
so the way that the plan is constructed, as we discussed at the previous hearing, is based on AGR and networks. So giving you an example, Avangrid performance went from 65.3% in 2021 up to 85.2% in 2022. Networks, and it's a line of sight thing, so this won't come as a surprise that networks went from 62.77% to 81.41%. That then drives, because it's a bit of a line of sight in this, that then drives the percentage of the maximum award at CNG to go from 61% up to 73.2%.
okay. Thank you. And my other question was about the kind of what I think of as lag, and feel free to object to that term, but that we discussed before, that the amounts reflected on this tab and for 2023 are incentives that were earned in the prior year.
Mm-hmm.
I guess I'm a little confused how that works with the employee count, because based on this, it appears that there were 71 APA eligible employees in 2022 and then down to 60 in 2023. So what happens to those? Is that because some of them were transitioned to ASC? Is that?
You need to be employed at the date that incentives are paid. Should not have used the term bonus, incentives are paid.
It's the SEC term.
Yeah, yes, SEC term, in order to receive it. So it depends on who's currently employed as to whether or not they're getting those incentive payments.
Okay.
As well as there could be movements that occurred between the years, similar to when you saw like the EVP APA that we were discussing, or the union APA. Yesterday, there could be movements.
Okay. So, and I think we talked about this yesterday about there being a pro rata calculation, but just so I understand, if, for instance, an employee moved from the union to APA halfway through a year, the following year, would like half their incentive be at the union rate and the other half be at the APA rate?
Exactly. It's prorated based on the date of your new job and depending on where your new role is situated, union, non-union, APA, EVP.
Just to add to that, at a certain point of the year, if you join in the latter part of the year, I think after 31st of October, you're not, you're in the employee count, but you're not eligible to receive the award.
Okay, thank you. Just one last question on this attachment. I was just curious I noticed again, when I did the sorting, that in 2022, with the exception of the outlier that we spoke about the other day, Ms. Van Luling, it seemed like the overwhelming average for union employees was that $200 incentive. But then in 2023 for union employees, there was a lot more variance. Just generally, I was just curious what was driving that comparative variance.
Yeah, again, the union, it was, so for CNG Greenwich, it was a slightly different construct in 21. It was $400 per union employee maximum, and they only achieved a $200 payout. And then the following year, it flipped to a percentage. So it wasn't a flat dollar rate, it was a 1% max. It's based on 4 metrics. It achieved a payout of 0.75, so 75% of the maximum. So not only did the plan design change in a way, but there's a different, obviously a different outcome, $400 versus 1%. And then the achievements change year on year.
Thank you. And was that for both unions that changed to a percentage model rather than a flat?
I believe Hartford was already a percentage, so it was a harmonization.
Okay, thank you.
And sorry, they don't achieve the same, they're different payout awards. One got 0.5 and one got 0.75 by the looks of this.
Okay, understood. Moving on to attachment 2 for LFE 10.
We're here.
Thank you. I think we talked about this also during the revenue requirements panel, but this is the allocated incentive costs for the parent level companies that are the incentives earned by employees of Avangrid Management Company, Service Company, and I'm missing one, right? Oh, UIL.
Yes, correct. And this, again, it's the amount paid in those years.
Understood. So these represent the proportion of the incentives paid to these employees in the prior year as allocated to CNG. Is that correct?
Exactly.
Just a second, I'm just going through, you had answered some of these questions during the revenue requirements panel, Ms. Van Luling, so I'm just skipping over those. What is the, and I might have asked this, I apologize if I did, but what does the EVP acronym stand for?
That's the executive variable plan. So that's VPs reporting to MC members, management committee members, and management committee members up to the CEO.
Thank you. And I remember that from the hearing, so I'm sorry for asking you to repeat it. And I had asked the revenue requirements panel this question. I think I was referred to this panel. There are 2 employees here that are shown as EVP/APA. I think the understanding at that time, subject to check, was that those are employees that switched during the year. Is that
That's
accurate?
correct. They switched positions, therefore switched plans during the year.
Okay.
And just to add to that, so if someone was a VP reporting to an MC member, and then due to a reorganization, they became a VP not reporting to an MC member, we would default them out of EVP and put them in APA, and then it becomes a prorating in that year.
Okay, thank you. I had those questions about the employees that have no allocation, and I recall the response there was that those would just be employees who aren't doing any work that's being allocated to CNG, correct?
Correct.
Thank you. And I noticed as between 2022 and 2023, there were 2 employees with the EVP/APA designation in 2022, and then 11 in 2023. Do you have a sense of of why there was that increase in employees that transitioned between the two plans in 2023?
I'm just gonna sort one moment. Wait, maybe we just need to check the unredacted to give you an explanation.
And if it helps, I mean, I guess my question is,
Yeah.
is there a particular reason for this, or is this normal in the regular course of business?
It's normal in the regular course of business. We need to see the names to give you an answer, and it might take a minute to pull it up. So maybe if we keep going and then we can read it in for you, or I can read it in for you at another panel.
Sure. And to clarify, I'm not asking for the reasons for each instance. I was just trying to get a sense of, did something happen that caused this? Or is it just sort of individual circumstances?
Sorry, say that again? You're just looking to make
Sure.
sure that it's the normal course of business?
Yeah, what I said was I don't need an individual explanation for each of these 11 employees. I was just trying to get a sense of, was there some sort of systemic change or adjustment that caused this, or is it just so happens that 11 employees as opposed to 2 ended up changing midway through the
Yeah,
course
I
of the year?
mean, folks do, so I could give you an example. So in terms of somewhere like the control department, you have someone who was in APA and got promoted, and because they report in the administration side, because they report to an MC member now, the CFO or the controller, they become part of it. And then if you do, like, there's been some restructures where we've added, although the folks were maybe senior directors, etc., they've now become first line reports, so they've become EVP members. So that's why you're seeing that.
Okay, thank you. So I don't need to read it.
Perfect.
And I noticed comparing the years that I'd asked a second ago about the APA eligible employees who didn't have allocations, and the reason for that being that they didn't perform work for CNG to be allocated to the company. I noticed though that between the 2 years, there were 22 more employees allocating work to CNG than in the prior year. Is there a special reason for that, or is that also just normal in the course of business?
Well, when we were looking at the CNG specific, I think we quoted, if I recall correctly, there was like 22 less between the 2 years. So
Yes.
this is the natural movement of folks moving around and depending on who they're working for. So if you lose the direct employees and they've now gone to, say, ASC, and they're now allocating their time, you're going to see an increase to the allocations.
Okay, thank you. And I think this is probably a similar question, but the total allocated for APA eligible employees between 2022 and 2023 increased by about 25% from $711,676.02 to $891,475.36. Is that increase related to the greater number of employees allocated to the company?
It would be greater number of employees as well as the achievement. So the achievement was improved between those 2 periods, and so you didn't see an increase due to the achievement levels.
Okay, and that would be the same explanation, Mr. O'Neill, that you gave for the increase for the CNG specific APAs?
Yes, it would. It's the same plan, so the same rationale holds.
Okay, thank you. Looking at LFE 120 attachment 1.
We're here.
Thanks. On the April 2024 tab, there are 324 employees listed. I was just trying to get a sense of, is that a representation of the full amount of FTEs at the company as of that time? Or if I wanted to capture that, would I add the vacancies from the open positions tab to that? I can ask that question.
Yeah, no, I think that's, I think the way you've asked, so that is anybody in the census, if you want, at April 24. And then on the open positions tab, it would have further numbers to add.
Okay, so the total number of positions, whether filled or not, for April 2024 would be the sum of that, of the April 2024 tab and the 2024 positions on the open position tab?
It should be. The thing that we couldn't do was on the open position tab, obviously we couldn't fill in the full schedule because we don't know what those folks will elect into medical plans, because that's a personal decision. We don't know the deferral rate of a 401k plan. They may take it, they may not, they may max out. So that we couldn't complete that because we don't know all of that.
Thank you. And I did see that in the narrative response. And I think actually there was that caveat in the original hearing. I understand that. I was just trying to figure out the total number of positions with the understanding that the open position numbers are estimates. So I did that, and that I got a total of well, I found 23 positions in the open positions tab that were labeled for 2024. So the sum of those is 344 FTEs. So is that the number of positions that existed in April of 2024?
You're asking us how many open positions that there are in April of 2024?
Well, yes. My ultimate question is just trying to confirm how many total positions, both filled and unfilled, were accounted for as of April 2024.
So I see in the April year-to-date 2024 tab that there's 324 filled positions.
Yep, that I got. So then, but then I went to the
On the open tab, you're asking for the amount of open as of April 2024.
Yeah, well, I guess I'm just asking to confirm. So I'm looking at the open position tabs. There's the year column, which includes 2022, 2023, and 2024. So is that meant to say that those were the open positions within each of those years?
So if you add up the 2024 positions from the year 2024 column, there's 23 open positions in 2024.
Okay.
Could I add to that? There may be more because there could be some in process as well that are not fully open at this point.
Okay. The reason I'm asking is that I'm just trying to get a sense of, as this panel knows, the revenue requirement is framed in terms of FTEs, whether occupied or not, with the vacancy factor.
Mm-hmm.
So I'm just trying to get a sense of what the overall, what the proposal is incremental to.
Mm-hmm. Yeah, we requested 347 open positions within this case for CNG. And if you take the 23 and you add in the 324.
Okay.
Just to add to that, you can see the 347 Ms. Van Luling just referenced reflected on LFE 1 CNG attachment 2 schedule CNG WP C3.15, and the total CNG company number of FTEs in the interim period is denoted as 347, and then we add the incremental FTEs we're requesting on top of that.
Okay, thank you. Yeah, that was a clunky way of me getting to asking whether this exhibit ties with the 347 for the interim period count.
I think that it does.
Okay, thank you. And I was trying to come up with a similar sense for the level of total FTEs that were authorized for the 2021 rate year in 1805-16. And as the panel might be familiar, that settlement and final decision frames it only as an incremental count of 6 for the rate year. Do you know offhand what that 6 was incremental to?
I do. For CNG, my notes have a head count, and so I don't have the 6 in my notes, so I just have the total pre and post the vacancy rate. We have 341 as the head count gross of vacancies, and then 330 net of vacancies with a 3.14% vacancy rate.
Okay. Thank you. I just have a couple questions about LFE 124, which is about the calculation for the cost of absenteeism.
I'm there.
Thank you. So I saw on page 14 of the rebuttal testimony on line 11 that there's a $31,000 number for the cost of absenteeism. So that's derived from the same equation in LFE 124.
That's correct.
Thanks. Sorry, I needed to open LFE 24 before I went on. What's the basis for determining like what a saved work day is?
Can you clarify the question? The formula itself is to measure employees getting back to work, the absenteeism rate. That formula calculates, the whole purpose of the program is that they use that benefit so that they can attend work. And that formula captures that concept.
Okay, yeah, I understood that. I was just, is the input for the is the input for the number of days that the program, the number of days that are being counted as offsets to absenteeism, is that the number of days that employees are using the program?
Correct. We're assuming that the utilization is translating to them coming to work.
Okay. Thank you. And that was my last question for this panel. Thank you very much.
Thank you. BOE, please.
Good morning. For the record, my name is Brittany Wyman, and I'm joined by my colleague, Kim White. Before I get started, most of my questions are surrounding late file 125 with some other references. So you probably won't need to look directly at them, but it might be helpful to have them near you. Right off the bat, while I was reviewing all of the attachments, I had some issues reading the metrics criteria and some of the EVP evaluation forms. They seem to get cut off. Like even if you look at the first attachment, it just doesn't have the full thing. I did notice that in attachments 25 and 27, if you want to look at them, you were able to click and then the text shrunk and then I could read everything in there.
From a width perspective, it looks like the Excel.
Right.
Okay.
It just cut off. So is there a way they could be refiled as something similar to 25 and 27 so I can actually review everything?
The whole thing.
Yes, please.
Yes, yeah,
Okay.
yeah. She's, just to confirm, you're looking at LFE 125 SCG 01 redacted And
is
in
m-
that first column under metric 1, you can see it says like above GG 1-3 in, and then it's cut off.
Right, right.
And
And,
that's-
and it is not just attachment 1. That's an example. There's several throughout. I think, anywhere besides 25 and 27 that have multiple lines of text, they're cut off somewhere.
Yeah, we can do that.
On that note, for the APA evaluation forms, I noticed a couple of the attachments, attachment 6 being my example, where the comments referred to a separate document, which we didn't have. So instead of having the text be full explanation, just said, please see this other attachment.
1 second. I apologize. We had looked at this one. It is a separate attachment that we had pulled. If it's not in the record, that was an error and we will we'll put it in
Please.
the update for
I
you.
didn't see it. I won't guarantee that doesn't mean it wasn't there, but I didn't see it.
Yeah, we'll definitely double check, and if not, we will get it to you because we definitely pulled it.
Yes.
It was just for your purposes, when you do see it, it did cover a few different individuals, so it's not necessarily like specific to one individual, it's a group one.
So that may be the other APA ones that might have that in there.
Yeah, but we'll take a look and make sure that we respond in the in the
Great.
supplementals with that.
Thank you. And then my last on this note is there's similarly a few of the EVP evaluation forms, attachment 5 being my example, where the metric criteria just said something in this example, CHRO evaluation, but we don't have that evaluation.
Yeah, so on this one, for the measurement criteria, that would be the evaluation of the Chief Human Resources Officer. And so the achievement here, if it's 100%, the Chief Human Resources Officer gave this individual 100% achievement.
Okay, so are the metrics criteria listed out in that evaluation though?
No, it's, 1 second, let me double check, but 1 sec. There's not, on these ones, it's not necessarily like metrics that's listed out. It's just that that person's gonna give like, it's either a percentage or like a yes or no, they're just gonna give 100%. You're not gonna, there's no criteria behind it.
Okay.
It's basically like a performance evaluation of like, you did well, you got 100%. There's no words written down to provide you anywhere. They might have had a conversation on it, but there's no measurement like.
Okay, so I'm gonna ask a couple questions on that then. So for the very first metric and the first objective, it has data collection and assessment. And the measurement criteria, which is just that evaluation, would just say, yes, they did that?
Yeah, so so basically for these, so there's one on there, you can use data collection, but implementation of approved org design. So if we've got organizational restructures, say that there's certain parts of the network's business, then the business partner or the HR person involved in this, they would have a discussion with the CHRO, and she would know that that had been done. Obviously, that's an organizational change, an organizational restructure, so they would have a conversation. Typically, what you would see is probably an email, but just to declare, yeah, this has been done.
Okay, but what that entails, each of the duties or objectives isn't written out anywhere. So it wasn't preset prior to the year or something.
That we would need to check, but it's probably just general. That one's probably just general org design. So when there's, because you don't know, you may not know as they come up during the year. You know, we're in the middle of org design and org restructures come up all the time. So what they're saying is, look, when these come up, liaise with the business, make sure they're done effectively, make sure the systems all work, et cetera, et cetera. So you can't really pre-plan some of this because the business is so fluid.
Okay. I might get back to that later. I want to make sure I'm going in somewhat of an order that makes sense. Can you just check for me with the other ones that if there is a metric, a measurement criteria that does not actually list out that criteria, if there is an attachment or documentation listing that criteria, that those be provided?
Yeah, we can. My guess is for many of them, there aren't, but we definitely can.
Okay, thank you. Okay, that was the logistics now. All right, I want to make sure I understand a few more things. So the evaluation forms that were provided, LFE 125 for CNG, and it was just the one set, and that's for both companies, just because SCG referred back to this one.
Yep, yeah. It's the same listing of officers.
Right, right.
Yeah.
Okay, and those evaluations were for 2021, but paid in 2022. Is that correct?
That's correct.
Okay, and so in UPA 1, there's the two tabs, 2021 and 2022. Which would that one be for paid out? The 2021 tab or the 2022 tab?
We just need to pull UPA 1 second.
The other one I will refer to at some point is UPA 9, if you just want to pull it up.
So UPA 001 CNG attachment 1, the 2022 test year information includes it's called bonus, the SEC format, the incentive comp. This is based on the 2021 performance.
Okay, so it is the tab that's labeled test year 2022.
It's both. Yes.
Okay,
And it's also in the non-equity incentive plan compensation.
thank you. Okay. And similarly for UPA 9, the plan types that are listed for each employee, are those for what were eligible in 2022, or were they what was paid out in 2022?
So all of this information was the same between 2021 and 2022.
Okay, so there should be some correlation between what plans are listed in UPA 9 and what plans were listed in 125.
Yes.
Okay. For in 125, there's 5 employees that were either ineligible or removed from receiving payment. Is that correct?
Yeah, that is correct. There were 2 or 3 people who, although they're in the 2022 listing, they weren't eligible because of the date they joined the company.
Okay.
And then I think there was a couple that they were involved in lobbying, so there was an adjustment made to remove them from the revenue requirement, and therefore they're not in this, they were removed.
Okay, but if those employees are listed in UPA 1 with some benefits that they received, incentives that they received?
No, they shouldn't be listed as having, they shouldn't have EVP or APA because they weren't eligible.
Okay.
They will have salary, they will have medical costs, 401k, etc. for the year, but when they're not eligible, they won't receive the AVP or EVP or APA.
Okay, so I believe the officer numbers correlate between 125 and UPA 1. So for example, Officer 20 in both, it stated that they did not receive or removed. But in UPA 1, they have that they received the non-equity incentive plan compensation.
So you're looking, I just want to make sure I understand your question. You're looking at Officer 20 on UPA 001 and saying that it shows that they have incentive compensation. And then what was the second part of your
Well,
question?
let me start with this question first. The officer numbers in 125 correlate directly to the officer numbers in UPA 1. Is that correct?
1 second.
I'll say I assumed they were since the request was based off of UPA 1 and 9.
I think so. I just want to double check. Yes, they are.
Okay, so Officer 20 on late file 125 states that they were, and I just had it up and I should have left it up. They were removed.
Yes, that's correct. They were removed from the revenue requirement.
Okay. But I still would like their metrics because this wasn't necessarily based on if they were in the revenue requirement or not.
So that is the VP of Government Affairs dealing with federal level activity and lobbying.
Okay,
You want the metrics?
I would like to see.
I guess I would ask the relevance of that. The company's taken those costs out of the revenue requirement, and therefore there's really no purpose to that.
Well, okay, of the compensation that they received, Officer 20 in UPA 1, a percent that was allocated to the utility was 3.89%. None of that was incentive compensation?
We removed their incentive compensation from the revenue requirement in the most recent revenue requirement update for officers 20 and officers 21.
Okay, but part of their salaries is still being covered by CNG ratepayers.
Yeah, 1 second. So what we have not provided was the document that supports their incentive compensation because we did not include the incentive compensation within the revenue requirement. Regarding their base salary, your base salary job responsibilities are not necessarily what your incentive compensation metrics are that would guide your incentive comp. So they're meant to be different to
Okay.
drive high performance. What we could do for you, because we've included the salaries in here, is include job descriptions and what they're doing and why it's relevant to CNG.
1 second.
Sure.
That's fine. You don't have to submit that. I appreciate it.
Okay.
For Officer 21, I presume it's similar since it's removed.
Same,
Says-
same.
It's state government relations.
Okay. And Officer 22, 35, and 36 were all ineligible.
Yeah, they weren't, and so I'm looking at a colleague of mine in HR. She wasn't in the company at that point, so she wasn't eligible because she just joined on a certain date.
Okay, so for Officer,
That we only answered 22 on that question, but I think you named 3.
5 and 36,
1 second.
we can go one at a time. So for Officer 22, they received stock awards and on UPA 1, it was all other compensation. So those are not incentives?
No, we're talking here about short-term incentives, AP and EVP. Stock awards are long-term incentives, so they're granted, they'll have been granted on joining.
Okay,
yeah.
so that's not a criteria or metric base, that was a signing bonus.
Well, no, the LTIP is metric based. There could have been a signing on bonus as well, I'd need to check, but the LTIP is metric driven. It's just that you're granted as you join, and then there's a 3-year performance period and a 3-year payout period.
Right, I remember you explaining that to me last time. So they're different metrics though?
Yes, they are different metrics that I think we previously went through them or filed them. We've definitely done that.
But the LTIP metrics are one set of metrics for everyone in the LTIP plan. It's not individual based. So either whatever the LTIP achievement is, say it's 85% or 70%, everyone gets the 85% or the 70%. It's not an individual, you don't have an individual component of it.
Okay, if someone is able, while I'm asking questions to remind me where that is. I
Sure.
appreciate it.
Yeah,
So the same would be for,
just to make sure you're looking for the criteria for the payout for the LTIP.
I assume, so all other compensation and the stock awards are LTIP as it's listed on UPA 1?
Might be also, you'll recall us talking about shadow shares. I think that might be wrapped up in there as well.
Okay.
And there could be like other,
Within those
Yeah,
categories, but those
other types of-
categories
yeah.
are the
I would say the bulk majority of it is the stock compensation plan.
Okay. Just to make sure I fully understand this. So on UPA 1, and I do believe you went through this in the hearings, but I want to make sure. The bonus is EVP APA.
No, the bonus on that case is EVP and it's as per the dictate of an SEC reporting requirement.
Okay. Okay. And then stock awards would be essentially a part of LTIP or that global?
That is LTIP.
Okay. And option awards, not that there are any, would
We
be,
don't have.
you don't do them. Okay. And then non-equity incentive plan compensation is,
That's EVP
Also-
and APA.
got it.
The part that's not dictated by the SEC, so the SEC dictate is only on named executive officer.
Okay. And then all other compensation similarly is that LTIP?
Well, it's not.
Or-
no,
or
no,
various other
yes,
items.
Various other.
Okay.
Yeah.
And outside of LTIP, are there other sets of metrics for the other components of all other compensation? Or is that just general?
No, we're unaware of any of the other compensation being metric driven. It's stuff like travel reimbursement
Sure. Okay, that makes sense.
or sign-on bonuses for and the shadow shares that we previously discussed.
Okay, thank you. To take a left turn real quick. Late file exhibit 10, I was trying to see how they all correlated. Specifically attachment 2.
We're here.
Are any of the officer signifiers the same? So for example, since 125 is based on a 2022 payout year, I would assume that's the 2022 tab.
So the UPA, I lost the reference 1 second.
One.
Yes, one is prepared this in the same structure as the mandated SEC reporting. And so the officers should be the same as what you're seeing on LFE 010, attachment 2. It's
Oh, when
slightly,
sorry, when you said, oh, when I was like 1, that was my fault. So for attachment 2, I want to double check and make sure. Right, give me 1 second. Oh, yes. So on UPA 1, it goes to Officer 40, but in LFE 10, it goes to Officer 38. Who would be 39 and 40?
So UPA 001 is meant to reflect the officers for CNG, which some officers for CNG and SCG are not officers of all the other entities. And when we pulled in LFE 010, we were looking from AMC and ASC perspective. Those two people are on this LFE 010 CNG attachment 2 listing, but they're not listed as officers because they're not officers at the AMC or ASC level.
Do you happen to know which ones they are on here?
No, but I can get that for you. That's easy.
And between the two tabs, 2021 and 2022, they're roughly the same, understanding that most of them might have, okay. Now, a few general questions. In your response to 125, you state that employees who are eligible for the APA incentive do not receive those incentives based on objectives or points, is what I understood. Is that correct?
That's correct.
And they have the like performance review.
Mhm.
In UPA 9, you do list the points that are allocated for individual performance. How do those correlate? Is it just how well you did on your review is the percent of those points?
Yeah, I'll let Mr. O'Neill chime in if I speak incorrectly, but it's depending on what level you're ranked, that corresponds to the percentage that you get of the maximum points. So if you get the highest level, you're going to get 100% of those potential points. If you get the 4 out of 5, you're only going to get a percentage of those points as the 4 out of 5.
Okay. And so for this year, that would be that original APA agreement, is how that would be dictated.
Exactly.
And similarly, the points have changed in the new one, so it would be the same.
Yeah, the points haven't changed. The allocation of how the points are distributed have changed.
It's still 1,000 points,
Yes,
but it's
yes.
now, okay. For the EVP incentive evaluations, how is it generally determined how many objectives one might have?
Yeah, we tend to have a criteria no less than 3 and no more than 6. So we set that, we tell the participants, and then there's a criteria around how many individual sub-metrics you can have underneath those metrics. Because we don't want 46 because it's unmanageable. So yeah, we do dictate to them how many they can typically have.
Okay, and it's more of it's purely a range, and ultimately those objectives would have to equal however many points they're required per, I think it's what, 600?
Yeah, that's correct. That would be for that would be for an individual in the networks or the networks business. The points are slightly different for the corporate functions, but typically 600 for the individual, 250 for the networks business, and typically 150 discretionary based on the executive above them is looking for a little bit more on those objectives. So that discretionary assessments for like the icing on the cake, if you want.
And so it doesn't mean that the metrics underneath the objective are supposed to equate to the objective point allocation?
Yeah, so if you had an individual financial metric of say 100 points and there was 2 aspects to that, it may be 15-50, maybe 75 and 25, that adds up to 100. And then if you've got 6 of them and they're all at 100, that's 600. Unless I'm sorry, if you could clarify your question.
Well, as I say, so I saw one of the objectives was worth 200 points, but there was one metric underneath it that's worth 100 points. So that's a weighted.
Yeah, that would be as if the sub-metric's worth 100, there's another one worth 100, so it's 50-50 on that. Yeah, yeah.
So I believe it was just one, and I can point to you to a few of the spots I saw that. If you go to attachment 2, that'll similarly do.
Are you talking about LFE 125?
I am, I'm sorry.
We're here.
I moved without telling you. So in attachment 2, objective 3, there's one metric.
Yeah, is that the one that says the announcement?
Yes, but there's just, it's just the one metric that's worth 100 points, and the objective is worth 200 points.
No, the objective, sorry. That, what we're looking at there is the in extrapolation, the 0 to 100%. So it's worth 200 points. On the far right column, far right left column saying possible weighting in points, it's worth 200 for the announcement of 3 transactions. It's saying you can achieve between 0 and 100. So if you got one of them, you'd get a third of 200 points. This person got all of them, so they got 100% achievement and achieved 200 points.
Okay, can you can you explain to me how each one of those numbers works? Because I think I'm more confused now. So for the objective, that very first number, so let's talk about objective 3 still, it says 200, and that is the value that it has for the entire 600 points that they could receive.
That's 200 out of the 500 points, because this was 500 points.
Oh, excuse me, 500.
Yeah.
And then after that, there's the title of it, right? That first line for objectives of what it's supposed to be. And then there's a 0, which is the low end, and then the 100, which is the high end.
Yes.
Okay. And then, so for metric 1, that first number is 100. What does that 100 represent?
I would say this is the problem. Folks fill these in themselves. That actually means 100%. It's 100% of 200 points. Yeah, sorry, it is a little bit confusing.
The math has been a little.
Yeah, no, that's
yeah.
what that is.
Okay, and so then the 0 to 3 is what you were saying before, where 0 means they did nothing, 3 means they had 3 items they were supposed to have done and could have completed.
That's correct.
Okay, and just to make sure I fully confirm my understanding, above that objective 2, it's worth 125 points, but then the metric has 100.
No, the metric is 100%. Again, it's
That's
saying
100%.
if I achieve 100%, I'll get 125 points.
Got it. Okay, that is helpful. Thank you. All right, let's go. On a few of the evaluation forms, I saw that there's an Everyday Better program. What is that?
Yes, it was a program that took place in 2021. The purpose was to make general improvements, right? Focus on making sure that every day we are getting better and better. And so it was bifurcated amongst all of the divisions, and each group went through and came up with individual goals or strategies of how to make every day better for Avangrid.
And that's essentially reflected in.
Exactly, yeah. So, like Mr. O'Neill was mentioned earlier on, like that guidance of like 3 to 6 goals. Sometimes there's general programs where it's encouraged. There's this general program and that should be included within your goals. Like you see a lot of diversity and inclusion.
Right.
So certain members get an email from HR saying, you have to include a diversity and inclusion goal. And so there's certain of them are more widespread for broader initiatives.
Okay, thank you. And hopefully this is close-ish to my last topic. To again, make sure I understand how everything relates. For late file exhibit 125, you've listed their plans, right? I went over this earlier, the APA versus EVP, and there are 2 in here that are APA and EVP. Are the amounts reflected in UPA 1 for both APA and EVP? It's officers 10 and 13, if that's helpful.
Yes, it's going to be the prorated of the both of them.
Okay, and there are a few in 125 that list them as APA, but their correlation to UPA 9 and understanding that the names are redacted, I'm going to be careful here. Say it's APA versus EVP.
Yeah, so that's gonna be depending on, because depending on how you're looking at the program, because we're always a year behind when you're looking at the paid for the prior year. Your paid in 2022 is related to your 2021 plan. So if you moved in 2022 to an EVP plan from an APA, you were paid out on APA, which would be the assessments that you were provided, but now you're in an EVP plan.
Okay. I want to make sure I understand that. One of the officers, Officer 14, was one of those offers. I am picking a random one. Since UPA 9 is kind of both 2021 and 2022, that move could have happened sometime in there. Is that what you mean?
I think that's one of my colleagues in HR. So she was not reporting to an MC member, and then she got promoted into a VP role. So I think in that snapshot of time, at one point she's an APA, you run the snapshot as Ms. Van Luling has done, and then she's moved to EVP, but Officer 14 is definitely someone subject to that transitionary move.
Okay, great. And so the amount that correlates with this person in UPA 1 would just be the APA.
It would depend on when she moved. It may be a prorating depending on at the point in time she moved. So if you move in June, you may get 6 months of APA and 6 months of EVP. So it could be both. But I think what's happened on that schedule is they've probably just listed the last plan that they're in. It's a little bit confusing as people move.
Right, which I would understand. So Officer 1 was one of them as well, but we were provided the EVP and not the APA evaluation.
He is one of the individuals that moved as well. And so what's reflected for that particular individual in the test year is his current moved role. What he was doing prior to that was not relevant to CNG and SCG. So we provided the documents that are relevant to CNG and SCG to support what we're asking for in the test year, because he moved right in the interim period.
Okay, I'm gonna ask a broader question because maybe that's helpful. For the officers that were in this move, but we were only provided APA, would that reflect that the amounts in UPA 1 would only be APA?
They're both APA and EVP.
They would be both. But do you have an EVP evaluation for those, or would you only have the APA evaluation if they moved?
For the 2022 test year, that shows the 2021 payouts. They would only have an evaluation of what they were in for the year. But if they move, that's the only eval that's available for the 2022 test year. If for one second.
So if someone moves into EVP, the construct of that year is mainly done around the last plan you're in. And then for the prorating, there'd typically be discussions with the previous person that they worked for to evaluate what the prorating should be for the previous plan.
Okay.
But the minute you join EVP, you're getting hard and fast objectives in the EVP plan.
Okay, so there's a handful of officers that fall into this. Go ahead.
I'm really sorry to interrupt you. Specifically on that Officer 1, what's included here for the incentive compensation that's in the revenue request is related to his 2021 performance year.
Mhm.
He, effective in 2022, was promoted to a different role that very much served CNG and SCG. We did not update the requested incentive compensation amount, but now he was in the EVP plan versus being in the APA. But we provided you the EVP documents because that's what's relevant to the CNG
Okay.
and SCG, and that's what's in the test year. And we're actually incurring an amount higher than what we've asked for in the test year because he was in the lower plan, if that's helpful.
It is. And so I guess it's for the rest of them. I'm just trying to figure out if they have applicable EVP evaluations that would be reflected in
Yeah.
A1.
And so this is the only instance, Officer One is the only instance in which we did that because
Okay.
of the significance of the role change.
Okay. So the rest, it's fair to assume that even though they might be listed as both, the amounts that are reflected in UPA1 are their essentially APA incentives.
It's whatever they were for the year in 2021. So if they serviced an APA for 6 months, it's an APA for 6 months and then EVP for 6 months.
Okay. Give me 1 second while I make sure I understand. Okay, I actually think I understand it enough. So that was my last question.
And I know it's been very confusing, but Officer One was a unique situation. So that's the only one in which we've provided you an EV program where their payout was based on an APA plan.
Which I appreciate. So thank you.
Your understanding is very good considering how little time you've had to read this.
Thanks. All right. Thank you again.
Thank you.
Thank you. That's it for you. Pure staff, please. English.
All right. Thank you and good morning. This is actually going to be very brief because Attorney Wheel stole a little bit of my thunder asking about 4/30/24. But I did have a quick follow-up, not a follow-up about 4/23/24, but I'm looking at LFE 120 and the corresponding attachments that go with it. The question I have is that the request had for each time frame to list out separately current employees, and any employee position was either new to the company or vacant at that time. And I did see the tab that lists 2022 through 2024 that Attorney Wheel had referenced. But I guess, I don't know if there was just some miscommunication or maybe I'm just missing it. I was also looking, I had envisioned a separate tab for 12/31/22 and 12/31/23. I did not, so essentially what I'm asking is I did not see those two timeframes listed out separately. I might have just missed it.
And I apologize if I'm misunderstanding, but I believe we did include those two tabs there in the middle. So if someone can pull it up, LFE 120 CNG attachment 1, it might be confusing because it's called YE, meaning year end,
Right.
2022, and YE 2023. But those are the positions as of December 31st, 2022 and December 31st, 2023.
Right, but do any of these list out whether they were new or vacant at that time?
So the open positions listing includes the year, if you go to column B, and it shows the years in which the positions were vacant.
Yeah. Oh, okay, yeah, yes, I did see that. I guess a better way to frame it is that, just to kind of confirm that that is the year end 12/31/22. Yeah, 23, that basic confirmation. Because I did see that the year was there, and I was unsure if that was maybe had meant May or.
Yeah,
June or
no,
something.
sorry, year end.
Okay,
sorry.
okay, excellent. All right, so.
Love acronyms.
Yeah, yeah, absolutely. I know I'm familiar with the year end acronym. Okay, well, thank you for that clarification. Like I said, that's basically the only question I have at this time, given Attorney Wheels questioning earlier.
Thank
So I
you.
thank you very much. I appreciate it.
Good morning, Jim Boccolina, your staff. You turn to late file exhibit 123, please.
We're here.
Starting with the last paragraph there, where it references an incorrect company code used in the posting for the internal postings. What is the significance of that statement?
So what happens is when we go to post a position, we have to put the company code on it. There's a specific company code for each operating company.
Mhm.
And the reason we have transferred back to the OpCo from the service companies is that in the process, someone inadvertently, a human error, put the wrong company code. They charged it, they allocated it to a service company when it should have been allocated specifically to the operating company. So over, I think that it said 2017 to present, which is like 7 years, we've found 3 errors where they had to be transferred back.
Okay, are you saying that when this was originally done, the incorrect error code was put in for for a particular employee, so therefore for that whole period of time, or just make sure I'm understanding for the 7 years since you noticed
Oh,
this, or no?
No. So what happened was, I'll
Okay.
give you an example. So supervisor of customer billing,
Yeah,
that job would have been posted in 2019 or the back end of 2018. They've allocated it to UI Holdings Corporation. It should have been to CNG or SCG, CNG in this case. And in the audit, and there's frequent Miss Van Luling's team check, the teams in HR check, the business check. They've noticed that and they've corrected it then. So in February 19, it's been corrected and it's sorted.
oh, so it's a relatively small period of time that this incorrect code sits there,
Absolutely.
less than a year?
Oh, by for sure. Yeah, it has to be, because then the employee would have issues with other things like systematic stuff. So yeah, it's got to be.
Checks and balances, okay.
Yes.
Okay. The late file exhibit requested information similar to what was provided in ROU 538, which would have included fully loaded salary. And I don't see that on here. Was there a reason that that was not provided?
You said 538?
538 was the reference for late file exhibit 123.
Just to clarify, Mr. Vocalina, are you after the salaries for these individuals?
Yes, so the original request, went back and looked at the transcript, was to provide it in the similar manner that 538 was exhibit, or RU 538 was provided. And you have 4 columns here. What we're missing is the loaded salary, and we'll get into the test year allocation
We can do that.
after you can provide a supplement 123 to provide
we
the
could do
loaded
that.
salary, okay? Now, when we get to the final column, which was in 538, which was the allocation, it's the relevant number we would be looking for here would be what, any particular employee that moved from a service company to an operating company had allocated to it in the test year. Would that be correct?
That's correct.
Okay. And then, after the transfer, they would be 100% allocated to the operating company.
That's correct.
Do you have that particular information for these employees?
Yeah, we can get you that.
Okay.
Absolutely. Oh, okay. Just to clarify, they all moved before 2022? So in the test year, there's nothing allocated. Are you looking for what they were allocated in the years?
Sorry, go ahead.
No, go ahead.
The time of transfer.
Okay, so-
Yes, not specific to I'm trying to track the dollars that are going in any particular year. And
The
then
year,
movement.
the year that they moved?
Yes,
So if they moved in 2019 from ASE to CNG, you want to see when they moved in the dollars that they were previously allocated and then now the 100% allocation?
yes.
Okay.
What is the allocator, or the multiplier from salary to fully loaded salary? Do we have that in the record currently?
I think it's on it's on one of the data requests, I recall it.
Okay,
I can't recall the number, apologies.
okay, I'll search that. Is that relatively consistent over the years?
I would say
The percentage?
reasonable, yeah, absolutely, reasonably consistent.
Okay. As we mentioned at the time, rates are set and employees designated to service companies, their time is allocated to various operating companies, correct? And CNG, SCG, UIL, Berkshire, I believe there's others that
Yep.
you've mentioned there. All service company time employees are allocated to operating companies. There are no, is there an occasion for a service company employee to be allocated to another service company?
So you could have you can have instances where service company employees will direct charge an entity. Or direct charge two entities if they're working on a specific project or working on two entities. You could have an instance that a AMC or an ASC employee was charging UIL, which is technically another holding company, and then UIL would be allocated down to CNG and SCG. So you could have an instance of that.
Okay, thank you. Oh, I should get the reference.
Yeah, and not all, the majority of charges are allocated down, but like we've provided in certain data requests, certain charges are not allocated. They are held at certain levels.
So I mentioned UIL previously. I obviously mentioned UI, the EDC. I was not referencing the holding company, just, I'm sure you understood that. Okay. So when those allocations are made, when setting rates, there's an expectation that these employees will provide services to those entities. And when the employee is moved, I think as we discussed previously, and I've sort of acknowledged here, those allocations that are split out to all these particular entities, whether they be operating companies, or whether the occasion is for holding company, those services no longer go there, and this employee is dedicated 100% to the operating company that they go to.
Exactly, or vice versa. If they were a CNG employee and now they're an ASC employee. If they're an ASC employee, they could be an ASC employee working on just gas operations, in which they might just be charging CNG, SCG, Berkshire Gas, and then the two New York gas companies.
And that will continue on until the next setting of rates.
Exactly.
Okay. Just going back to late file 23. Would you agree that we have 3 employees here that have moved from operating companies to service companies, which since 2017 only impacted a couple of years. You have one in 2019 and two in 2021.
Yeah, Mr. Vocalina, they went from service companies to the operating company. Yeah.
I'm service for
yeah,
the operating.
yeah,
companies.
yeah.
Sorry if I misspoke. And the late file exhibit also asked if this transition going both ways would occur into the future after the setting of these rates here. Is the expectation that this will continue to occur?
As the business is continuing to evolve, we continue to move the employees as needed to make sure that whoever they're servicing is getting those services and that they're charging the correct entities. So from a holistic perspective, my recommendation or my feelings is that holistically, the revenue requirement as of right now and as of those requirements, which should not drastically change, is materially correct for where employees will be. But there will be movements that occur subsequent to this that would not be reflected theoretically in the revenue requirements.
Okay. Okay, those are all the questions I have. Thank you.
I should say there could be movements, but I can't guarantee. I don't know of any movements that definitely will happen, but there could be movements just as there have been in the past.
Okay, thank you. Those are all the questions I have.
Okay.
Thanks.
All right, Attorney Wright. Thank you. Commissioner Karen. Okay. Just a couple for me, please. Harkening back to clarifying question off of an exchange you had with an earlier attorney, please. I just want to make sure I heard this correctly. There are, you're talking to Attorney Wyman about UPA 1 and 9, I believe, and then there was the back and forth about the removal of the incentive comp for officers who I understood the justification to be that the incentive comp was removed because it corresponded to lobbying activities. Did I follow that correctly?
Correct.
Okay, but the underlying salary for those positions, the company has included in the revenue requirement.
Correct.
Can you tell me what the justification is for removing just the incentive comp for lobbying, but not the base salary, please?
Sure. So you have a certain set of roles and responsibilities, right? That is your day-to-day job responsibilities. And then what your incentive comp is based off of is certain specific metrics that might be related to your day-to-day, but should be something that's a stretch goal, right? Because it's incentive comp. So we want people going above and beyond on a daily basis to do these certain tasks. And so not 100% of their incentive metrics were related to lobbying activities, but they did have certain metrics that were related to lobbying activities. And so we took the entire incentive comp out. But their day-to-day job is not lobbying. So they're not necessarily doing lobbying activities. And their day-to-day job does have benefits to CNG and SCG.
Is there a quantification of how much time those positions spend on lobbying out of 40 weeks or 40 hours a week or a year?
That's an excellent question. I'd have to go back and ask them. We have lobbying charge codes. So if they've charged those charge codes, then we would know from that. If they're also, I can tell you exactly how much is in the revenue requirement for those two individuals for CNG and SCG. But you're asking how much time did they spend on lobbying? And so we can go back and look at the charge codes. I'm not sure. We might have to talk with them to figure out that percentage, or if it's something that we track, but we can go back and discuss that with them.
I appreciate that's okay. Just to be clear though, what I could see in the record today, if I look at UPA 1-9 and then the late file exhibit, I could see what the revenue requirement is associated with those two positions.
Yeah.
But I do not I could not find in the record today the percentage of time that those two positions spend on lobbying activities as it's defined in Connecticut general statutes.
Yes, correct. So how much time, you would not find in the record how much time they spent on those metrics that were in the incentive comp. That's the reason that we took them out. That's not in the record. The one thing I would note for you is in the record, you're going to see how much total, including incentive comp, was charged to CNG and SCG or being requested in the revenue requirement. You then need to go to the updated revenue requirement for the piece that we backed out for incentive comp.
Understood. Thank you. Okay. Can we open late file exhibit 122, please? So I think the request for this exhibit was to associate the service company or the company with all of the officers and directors. And I think if I'm looking at column B, I can see the company that the officers are associated with, but I'm not seeing that completed for the directors. And I guess my question is, why?
Oh, the directors are not part of AMC or ASC or UIL because they're independent directors of Avangrid as a whole. So like they're essentially like an outside organization for the directors. They're not associated with like AMC. They're AMC or ASC employees. Yeah, and apart from the CEO.
So row 58.
50, yeah, row 58 is the only Avangrid employee on this listing. Yeah, so the reason that he is included on this listing is because he was a director prior to him taking the CEO position. And so now, once he took the CEO position, he was replaced with a different member of the directors. But he has been included because he was paid out for the portion in which he was servicing as a director.
Okay, thank you. So, so I'm trying to figure out how I can get to the same information that we were going to use to understand the service company association. I think maybe if you could walk me through whom else contributes to the director's salaries. I guess as a preliminary question, is it a correct read of the spreadsheet that each of the directors has 3.9% of their salary allocated to, in this case, CNG?
That's correct.
Okay, so conceptually, who makes up the other, what is that, 96.1%? Presumably SCG, whom we have a late
Yep.
file exhibit for.
Yep, UID, UI Transmission, NICEAG, RG&E, Renewables, all the other operating segments of Avangrid, it's split.
Okay, and it's allocated on the Massachusetts formula? Okay.
Yep.
Thank you. Okay. So the two questions I was alluding to earlier, which I wasn't sure if we needed the other witnesses for, and my apologies if not. I had questions during the evidentiary hearing about KPIs for gas operations and then personnel goals. And I think they were both referred to this panel, and I'm not sure we got those answers. So let me just pose the first question, which was, to what extent do gas operations KPIs impact compensation for union employees, non-union employees, executives, and officers? Thanks.
Yeah, so as we've discussed, the construct of this is individual level for the non-union, the networks business, and then the Avangrid business. So the individual KPIs at that level are pretty much embedded in the individual component. So if you see things like gas leak rate, recovery, etc., operational performance metrics are in the individual. For the union, it's health and safety, it's customer service metrics, it's operational metrics, all focused on that. But mainly the KPIs are at that individual level. And then at it goes up a level to networks. The KPIs are probably a little bit higher level than gas at that point, but they're mainly centered on the individual part.
Okay, and just to be crystal clear, when you say individual, you mean like each individual employee has their own individual KPI? I just want to make sure I
Yeah,
understand. what
they
you're
have their own set of goals or objectives, depending on whether you're in APA and EVP, and a lot of those KPI type, a lot of those KPIs are likely embedded in these goals and objectives.
Okay, so to say like the inverse of that, though, is there like a company-wide expectation of the KPIs that have to be met for gas operations, like at maybe the holding company level, and then those get assigned out so that individuals have to be able to roll up into that KPI? Or is it like the inverse where it's just all the individuals and then the company goal is the roll up of the individuals?
Yeah, give us a second. Yeah, it's pretty much as I said, I think at the hearing and here earlier, it's line of sight. So it goes from the top level. So Mr. Reynolds would have something around Connecticut companies, specifically possibly gas, and then it cascades down to Mr. Langland, and then it goes right down to supervisor level, and it stops at supervisor level. Although union staff do have the specifics that we discussed and filed.
Okay, thank you.
If I can maybe expand on that, best practice is the cascading, right? Because you set a goal, so I'll set a goal of whatever it is, and then cascade it down a level below what's applicable to them, and then that continues on that cascading. So a lot of times when you look at those APA goals, they're capturing that cascade effect of what they should be responsible. That's best practice, which is what is encouraged for all employees.
Okay, thank you. And that stops at the supervisor level.
For gas, that stops at the supervisor level. On saying that, just to repeat, the union staff do have their own set metrics, which are very operational, customer focused, health and safety focused.
Negotiate as part of their contracts?
Yes, that is negotiated.
Thank you. Okay. So I had a lovely conversation, I think, with Mr. Rudiak during the hearings around gas forecasts generally. And I had one question that I think had been referred here around personnel goals or annual goals related to the accuracy of the gas forecast. So the question is, are there goals related to the accuracy of the gas forecast?
We have goals related to the forecasting process, but a lot of times those goals are at a net income or an EBITDA level. And so in the specific gas forecasting, if there's a variance, it would not drive a net income or an EBITDA variance. If it had a net income or an EBITDA variance, then it would be included as part of those goals. But there's not a specific accuracy of gas forecasting at an EVP level in the EVP plans. Now, Mr. Rudiak's group might have a gas forecasting goal that is specific to his group, but it would not, there's nothing, you won't see anything for specific gas forecasting at the EVP level.
Okay, and is that because, so when you say it's no net income or net EBITDA, is that because it's decoupling would take care of the variances and prevent that from showing up there?
Specific gas forecasting, the gas component is all flow through for us. So any differences between what we've forecasted and what the actuals are net income neutral, meaning that we have the gas deferral for any overs or unders for what we're collecting, and that does not have an impact. And then to your point on the decoupling perspective, the non-gas revenues are all decoupled. So it's fairly easy for us from a forecasting perspective to predict what my revenues are going to be from a decoupled, because I know that that's all going to get trued up in alliance with what we've agreed to in the most recent rate case.
Okay. So, stepping down to like the Mr. Rudiak level though, is there a goal around like the accuracy of the forecast, in terms of like the perspective of the impact it has on customers when the forecast is, off, like from a volatility perspective?
I don't know off the top of my head for that level, but we could check his particular goals, and that group's goals and let you know at that level if they have anything included within their goals.
Would those be part of like would I have, I know 120, late file exhibit 125 has the names redacted, but would it be in there?
There's not, I recall you asking Mr. Rudiak this question, and I did check all of the responses in 125. None of the EVPs included in 125 have this particular goal. Doesn't mean that no one in the company does. I stopped at the EVPs that we had responded to for this. So we can go the level below and let you know if they have any, but none of the EVPs in LFE 125s do.
Thank you. And the level below EVP is?
They'd be in the APA plan.
Okay. Would you please supplement 125 if you find anyone in the APA plan who has an accuracy of gas forecasting related goal? I would appreciate that.
Sure. And just to clarify, there were some APA individuals included within 125. I did check those as well. None of those did, but Mr. Rudiak's group is not contained within those responses.
Okay, thank you. That's helpful. I think those are my questions. So thank you. Why don't we do this? I think we're due for a short break and you consider redirect. So would 10 minutes be appropriate for that?
Perfect. Thank you.
Okay, so we'll reconvene in 10 minutes.
Okay, while our panel gets situated, I can report we do not have any redirect. So,
Thank you. So we'll wait for the panel to get situated, but let me ask Attorney Wheel. Well, I think Attorney Wheel will be up first for cross, but while we're waiting for him, do you want to go ahead and do the stipulation, please?
sure, sure.
Thank you.
So to the panel, do you all recall answering a series of questions I asked you at the start of your testimony for CNG on the comp and benefits topic?
Yes.
Yes.
And do you also recall answering questions on cross-examination from OCC, EOE, Pura staff, and Commissioner Chair Gillette during that portion of the hearing?
Yes.
Yes.
And in appearing now for SCG and for purposes of administrative efficiency, do you adopt your testimony from the CNG transcript and stipulate that if asked those same questions again, your answers would be the same?
Yes.
Yes.
So with that, the SCG panel is now available for cross.
Thank you. Attorney Wheel.
Thank you. I actually have, I think, what I might frame as an administrative question first, which is that I have some questions about LFE 178, which I realized after my cross of the CNG panel was sponsored by CNG, and I believe by this panel. It's sponsored by Mr. O'Neill, excuse me. And I think I made the assumption based on the ordering, I thought it was going to be a customer service question. And there actually is I'm not sure. I'm not sure what happened, but because I look back at the transcript and I think actually LFE 178 was, according to the transcript, supposed to be a SCG exhibit of a different number. But according to the Pura website, it is a question about incentive compensation, and the company did provide that response. So I had already asked Attorney Venora if he would be okay with me asking it despite it being a CNG sponsored question of this panel.
Okay. Okay. Is there an objection?
No, we have no objection, and I can see in the sequence of the numbering, it's just stuck into the middle of another
Yeah.
series, so. no,
I
we
want to
have no
say it was a
objection.
read-in that got converted to a late
Yeah,
bottom
probably.
of order. Okay, so we can take that. While we're doing administrative matters, it turns out I don't think my questions pertained earlier to the witnesses you had asked to be excused. If no other party thinks they have questions, then I'm amenable to excusing those witnesses.
That's very much appreciated. That would be Ms. Brown and Mr. Lavulo, so we can
They
give
can-
them the all
excuse me.
clear. Thank you.
Thank you. Okay, so for purposes of our transcript, can we just be very clear when we stop the questions on the CNG and then we'll move on?
Yes,
Okay, then we can begin. Thank you.
thank you. I appreciate it, and thank you to the company for accommodating me. So I'll start with a question about LFE 178, which was sponsored by Mr. O'Neill for CNG. It pertains to the increase in incentive compensation in 2019. And it actually references, I think, Mr. O'Neill, something you were getting into earlier about forecasting and actuals and true ups. I just want to make sure I understand how that works. So that lay file is referencing OCC 98. And I had some questions about OCC 198 CNG attachment 1.
Mm-hmm.
Do you have that
Yeah, we've got the attachment and the document, yes.
We need to figure out how you guys get these things open so fast because we gotta up our game. So the 2018 expense in that attachment. For incentives is $218,000, and does that represent the incentives actually earned in 2017?
That looks like the ledger, so that would be paid plus any adjustment for the accrual that we explain in 178.
Yeah, thank you. I'm just trying to figure out, so like using as an example, from 2018 to 2019, there's that, well, and this is the basis for the original question, so would there have been some like baseline for 2019 based on 2018? I guess, could you just explain like how the forecast works?
Yeah, that's exactly it. So if we're basing the budget year on the previous year, which was a lower achievement, we then come into the actual year and it's higher. So we have to true that up basically. So we true up the actual, and sometimes it's under, sometimes it's over. So if we've based that on 2018, which was a lower performance year, and the accrual based on that, so we start accruing in 2018, it then reverses in 2019, the accrual reverses and we make the actual payment. And if we don't have enough, then we've got an under accrual situation, and then the expense in that year is higher. I'm
Okay.
sure Ms. Van Lullen could answer that much nicer than me, but that's what happens.
Yeah, just to expand about what Mr. O'Neill said. The accounting team will work with the HR team, and so we know what the total potential for any kind of incentive compensation is for the year, and they'll do an estimate. We think they're going to, on a whole, achieve 70% or 75%, and through each quarter, we'll update those expenses and that accrual to get to the end of the year. At the end of the year, you close your books, and then everyone comes in and does all of their assessments as to whether or not they met their goals, and the actual number comes in. And that in the natural process of like accruals and estimates and then actuals, there will usually be a difference, usually not material, of the amount that we've expensed in the prior year versus whatever I have to actually pay out. And that over or under is reflected in the year in which it's paid out. And this chart, like Mr. O'Neill said, is based on what was actually expensed for those particular years.
Okay.
And just one other point, in terms of the factors we discussed earlier, there could have been more people as well. Yeah.
Okay. I think I understand. So, so the $714,000 figure in 2019 represents a higher performance, or perhaps more people, a higher overall expense incurred in 2018 than was expected when the budget was created in 2017.
No, it's actually 19 and 18. So when the budget was set in 18, so we set the 2019 budget in 2018. When that budget was set, we've based on a certain performance level, and it's been higher.
Okay, I see. So the budget's, I think I understand. So the budget's set based on last year's performance, but also some indication of the current performance as of the time the budget is set.
That's correct.
Okay, thank you. Thanks. And that was my last question on LFE 178. So I'll switch now to just to CNG specific questions.
You mean SCG?
Yes, I do mean SCG. I will stop asking CNG specific questions and switch to SCG. My first question for SCG is about LFE 132. So during the CNG, I'll wait to make sure the panel has it.
We're here.
Thank you. During the CNG panel, I was asking questions about trying to ascertain the current total FTE headcount based on the LFE 120 attachment 1. It looks like LFE 132 attachment 1 has the same tab labeling, the April 2024, as well as the open positions tabs. would all of the responses about how to calculate the total FTE count and how to interpret those tabs, including to account for vacancies as well as the current count as of that period, would all that also apply to SCG?
It should just, let me confer with my colleague for a moment.
Sure.
Do we have 12 open positions on the open positions tab? And then we have 329 positions in the April 30th, 2024. If you add those two together to get to 341, those tied to the open positions pre the request for incremental head count that's outlined in Mr. Hurwitz will give the,
That's SCG C 3.15 is the schedule, and that's LFE 211, SCG attachment 2 is the most recent version of the revenue requirement.
Thank you. This question also might be for Mr. Hurwitz. During the CNG panel, I was asking about comparing the number of FTEs in LFE 20 and the associated revenue requirement representing the pre-incremental request, comparing that to the level of FTEs established for the final rate year in CNG's last rate settlement. Do you similarly know the number of FTEs authorized in SCG's final rate year for its last rate settlement?
I do. I closed my notes document, so just one moment, but I
Sure.
can get that for you.
And again, I see it's a similar situation where I can see the number of incremental FTEs allowed in that rate year, but I just wanted to confirm that what that would have made the total.
So for CNG, that was 341 gross of vacancies, 330 net of vacancies. The SCG equivalents of those are 348 gross of vacancies and 332 net of vacancies, and that reflected a slightly higher vacancy rate than CNG. SCG's vacancy rate was approximately 4.5% in the revenue requirement established in SCG's most recent rate case.
Thank you. LFE 136 is about the derivation of the calculation for absenteeism. Would the responses from SCG be the same?
Yes, it would.
Thank you. In just a moment, I to back up a tad. I'd asked a series of questions about essentially how to interpret LFE 10 and the attachments, which are the exhibits showing incentive compensation levels for both, in that case, CNG employees and allocated expenses. The equivalent for SCG is LFE 35 and the attachments. Aside from any particular numbers or any particular employees, would there be any difference in the responses to those questions?
no.
Thank you. That's my last question for this panel.
Thank you. EOE, please.
Hi.
This should be very, very quick. As I've done before. Earlier, UE asked the CNG panel a series of questions. In lieu of repeating each individual question, I am re-asking those for the record now and request that SCG stipulate that it answers each question the same as it did in the CNG portion of the proceeding.
They would be.
Go ahead, sorry. And then same with the requested supplements, if those could be as well. I think the vast majority would be LFE 137. Yep, great. That's it. Thank you very much.
Thank you. Peer staff, please. Mr. Bacalina, your mic. Oh, please.
There. Similar to other cross examiners, I asked you a series of questions on late file exhibit 123, which was for CNG. The SCG version is late file exhibit 135. If I asked you the same questions for SCG, would your responses be the same?
Yes, they would.
Okay. You also agreed to provide a couple of supplements for late file exhibit 23, including fully loaded salary and allocation as of the time of transfer. You still agree to provide those for the SCG version?
Yes.
Okay. And one slight difference here on for the record purposes on late file exhibit 135. The same information here shows 5 employees transferring from operating companies to service companies over 3 years, 2 in 2020, 1 in 2021, and 2 in 2023. Do you agree with that?
Yes, 130.
We can see that, yes.
Okay.
Yeah. Yep.
Thank you. Those are all the questions I have.
Could I just, Mr. Bacalina, before you go, I just want to clarify, because the supplement I had noted was for RRU 538. And
Correct.
Just
So
thought
this
we
would
would-
be, yes,
would
thank
be the
you. It'd
counterpart.
595.
595.
Yeah.
Thank you.
Thank you. That's it. Attorney Wright. Okay, thank you. Ms. Van Leuling, on the supplement to 125, the corresponding one is 137.
Okay.
If we could, please supplement that. And then, the questions that I asked the panel about late file exhibit 122 and the reasons why there wasn't a company assigned to the directors, are those the same for the corresponding late file exhibit 134?
Yes.
Okay, I think that's it from me. Thank you.
Thank you.
Attorney Venora, do you need a moment to consider redirect?
No, no, we're all set. We have no redirect.
Thank you. All right, then thank you to the panel. This panel is excused. Let's go ahead and start customer service before our lunch break, please. So I'd invite authority staff to the table and the customer service panel for C and G up first, please.
Well, I was gonna say just.
Okay. Okay, actually, Attorney Wheel, I think authority staff, don't have questions after all, so you're gonna be up first, please. Oh, sir, you're, it's not printed on both sides.
Oh.
Yeah. Thank you. Okay, Attorney Benoit, any? new
Yeah, so
witnesses?
we do have one witness who was previously identified but not sworn in during the main hearings, which was Mr. De Jong. So I'd ask Mr. De Jong to just state his full name and position for the record.
Richard DeYoung, I'm the Director of Internal Audit for Island Green Network.
Thank you, sir. And I think your microphone is not on, but did we catch that? Thank you. All right, sir, if you could please raise your right hand, I'll administer the oath. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury.
I do.
Thank you.
Okay, thank you. And just for clarification, the reason we had previously identified him with a different panel, but it relates to an internal audit report on customer service. So that's why we held till now, and he's available if there are questions related to that. So with that, I'm going to ask the panel, including Mr. De Jong, to let me just start here. I'm going to ask each of you, as part of your preparation for today's hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of the evidentiary hearings in this case?
Yes.
Yes.
And do any of you have any corrections or changes to any of your late filed exhibit responses not previously identified in a response to a late filed exhibit?
No.
No.
And with that, do you adopt your late filed exhibit responses as part of your sworn testimony in the case?
Yes.
Yes.
Okay, thank you. And with that, the CNG customer service panel is available for cross.
Thank you. Attorney Wheel, please.
Thank you. Good morning, Tom Wheel for the Office of Consumer Counsel. My first couple of questions are going to be about LFE 145. And I'm also going to ask about LFE 148 attachment 1, which is referenced in the response to 145.
Should have that up in just a moment.
Sure.
Okay, have them up.
Thanks. So first, just a couple of questions about the narrative response. I think I understood that the plan wasn't to shift 35% of credit collections calls from I-Core to Alorica, leaving the remainder with I-Core. But there is a consideration for outsourcing generally 35% of credit and collections calls and handling the rest in-house. Is that correct?
We did not propose a scenario where so there is a scenario where 35% of calls would be handled internally with the remainder of the credit and collections calls being outsourced. Yes.
Okay. So would that'd be 35% of all calls internally, or is it 35% of credit and collections calls internally with the remainder of all calls, meaning 100% of the general customer service and then the remainder of credit and collections being outsourced?
No, only the credit and collections calls would be outsourced. And we did put forth a proposal to look at service related calls being outsourced in order to offset some of the costs associated with having to insource those calls. But the proposal was to insource 35% of the credit and collections calls, and the remainder of the credit and collections calls would remain with an outsourcer.
Okay. Thank you.
And that obviously is doesn't change the fact that our move-in, move-out calls, which are currently being outsourced, would remain being outsourced.
Okay. So as I understand it, none of the proposals being considered would shift, would outsource calls that are currently being handled in-house. Is that correct?
We looked at the different call types that are currently handled by the company. And when we looked at the complexity of the calls, we didn't feel that there was another call type that would lend itself well to being outsourced, with the exception of service-related calls. So there was a proposed option if the request was to offset costs, created by insourcing credit and collections calls, that there is a potential to offset some of those costs by outsourcing service-related calls.
Okay,
But the remainder of the calls being mostly general billing inquiries, are very dynamic and at this time would not lend themselves well to being outsourced.
thank you. Yeah, and I was just trying to, the reason for my question was just trying to keep straight the options, I wasn't trying to suggest that the company should be outsourcing more calls than the 35% option. But so just to clarify sorry, I think I'm confusing myself, but what calls are currently outsourced?
Currently, as of today, that 100% of the credit and collections calls are outsourced. Those calls are currently handled by ICOR and are due to be transitioned over to Alorica. We're in the process of transferring 100% of those calls, transitioning those calls from ICOR to Alorica. At this time, also, the move-in and move-out related calls are currently outsourced, and they are currently being handled by Alorica.
And I would add, as we mature as a contact center organization, we'll continually monitor our calls. And if we get to a point where calls are easier to manage, we would consider outsourcing those as well.
Okay, thank you. So I just had a couple of clarifying questions about LFE 148 attachment 1. Can you tell me which of these options is in the proposed revenue requirement, if any of them are?
And Attorney Wheel, I heard you reference LFE 148 attachment 1. I just want to make sure you're aware we filed a revised version of that attachment, I think yesterday morning, potentially.
Yes, I am. Sorry, that was actually in my notes. I am looking at the revised version. Thank you.
In that revised version, the amounts reflected in our proposed revenue requirement are the amounts in the second row of information labeled company updated filing.
Ah, okay. Thank you. So the filing total of 2.86 million is what's in the proposed revenue requirement?
That's correct. And just for clarity, you won't see the number 2.860 anywhere in our revenue requirement schedules. Rather, what you will see is a number of incremental FTEs on Schedule C3.15 that includes the 14 customer service reps and 3 support staff denoted here. And you will also see on Schedule C3.05 an amount for outsourced call taking vendors that includes the 1.873 million approximately denoted here.
Thank you. I guess I'm just a little confused. So the variance to updated filing column, if it's a negative, does that mean it's a reduction to the revenue requirement?
It means the total cost of that scenario in the column header filing total is less than what's in the revenue requirement.
Okay. So for instance, the last option, which is transition credit calls from ICOR to Alorica, where it says filing total and it's the 1.801 million, that would be the revenue requirement impact if that were if that were ordered, then.
Correct, recognizing
Okay.
that, again, you wouldn't see a reduction of 1,058,000 or 1,059,000 approximately. Rather, the reduction would be, some portion of that on C3.05 and then the associated incremental FTEs, but conceptually, yes.
Okay, thank you. And on that same, I think this is probably a question back to Mr. Daniels. On that same row I just referenced, the transition credit calls from I-Core to Alorica. I was just a little confused by that because I thought that's what the plan is. Is that not? I thought that's what the shift to Alorica that's currently occurring is.
So that is our plan. However, we did want to reflect that within these scenarios so that there was a full understanding of impact to revenue requirement in each of the scenarios. So if we stay the course with the transition plan to Alorica, we wanted to depict the impact on revenue requirement and also be able to I think we spoke in earlier testimony that this option wasn't available at the time of the filing because Alorica had recently been onboarded and through review of their performance, we're at a stage where we are comfortable with the call quality that they're delivering and do want to reflect the potential cost to customers with this scenario versus the proposed scenario in the filing.
Okay. I'm still just a little confused, I think, just maybe by the timing, because I as Mr. Hurwitz just referenced, this was a revised exhibit. And I guess this is back to Mr. Hurwitz, does the row labeled company updated filing that you referenced before, is that the number that's in LFE 1?
That's right.
Okay. I mean, this is bouncing back to you, Mr. Daniels. I guess I'm just confused because if my understanding is that what the company sort of substantively proposes to do is the plan in the last column, which is a little over $1 million less than what's in LFE 1. So is the revenue requirement proposal not reflecting the last column, or is there going to be an update to LFE 1 somehow?
And maybe I'll start and then ask my colleague to add if appropriate. I think the most direct answer to your question is the very conclusion of our narrative response to LFE 148, where we describe that, well, as Mr. Daniels has mentioned, and it's been in testimony and data request responses, the Alorica transition is the plan, but the cost of that was, we weren't sure that fully met the known and measurable threshold because the exact timing of the transition and how it overlaps with the rate year and the level of transition costs that we may incur as part of that are, in our view, do not fully meet the known and measurable standard. And accordingly, we reflected in the revenue requirement what we felt was known and measurable.
Okay. So the calculation of the last column then, that 1.8 million potential filing total, I guess I'm just trying to understand like the company's actual proposal. I understand the sort of rate making principle that you just described, Mr. Hurwitz, but I guess I'm just trying to understand, like I'm reading the last column to be a reflection of what the actual rate year revenue impact would be for each potential outcome. And it seems like the outcome that the company's planning to achieve is the last one. So I'm just not really sure. I don't want to make you repeat what you just said, but I'm still not really sure I understand why the revenue impact that's reflected on the plan that is planned is different from what's ultimately being requested here.
So maybe I'll reiterate what I said at a new point and then ask Mr. Daniels to add if necessary. I think, again, we felt for the revenue requirement overall, it was important to me personally and to the company overall that we propose a revenue requirement that meets the known and measurable standard. And that was an overriding concern, not just for the I-Core Alorica transition, but all manner of proposals from gas operations, the capital plan, the increment, the FTEs, basically every element of the revenue requirement. We endeavored to make sure that we met the known and measurable standard. And in our view, this was nascent, new, for the reasons I mentioned. It didn't quite rise to that level. That said, LFE 148 Attachment 1 revised is intended to provide a roadmap of how the revenue requirement could be adjusted if alternative scenarios were selected. So we don't intend to change the revenue requirement we've proposed because, as I mentioned, we want one that comports with the known and measurable standard, but LFE 148 Attachment 1 revised is intended to be a roadmap, so to speak, for how these various options would affect the revenue requirement that we've proposed.
Okay. It sounds like based on your testimony, Mr. Daniels, it sounds like the transition to Alorica, there's been recent or perhaps ongoing information that gives the company increasing confidence in that plan. I'm just trying to get a sense of maybe whether the information that's incoming as a result of this ongoing transition is going to meet a known and measurable standard, and at what point that might occur.
One moment.
I'm not sure that I can give an exact date in which we would be able to say that it is known and measurable. It is an evolution of sort where we're monitoring the work that we're doing. We're also going to have to understand the length of time that it is going to take for Alorica to handle these calls, which would impact the cost per call, because it's a calculation of how long a call takes plus the cost per minute structure. That will take probably 60 to 90, or I was actually 60 to 180 days to understand where that AHT should lie, that would be reflective in the pricing. So it really is an evolution, and there could be measures that we identify that could impact AHT in a positive way, and there could be additional requirements on call handling that could change that handle time, and add additional handle time to it, which would increase costs. So I think it'll take post ramp up. We'll have to get through that learning curve, which is typically 60 to 180 days for us to really know what the costs would be.
Okay, thanks. That's helpful. So is this the sort of estimate that's reflected on revised LFE 148 Attachment 1? Are you using the current call time data for I-Core and just applying the Alorica pricing to it?
Yeah, and that's actually reflected in the second tab of Alorica costs, where we utilized the same average average handle time. We did make a change. We reflected the higher forecast that is consistent with hardship disconnections. And so it shows the cost calculation for how we arrived at the number in the first tab of the attachment. And while we certainly anticipate that this call option would be least costly or less costly than the I-Core cost, simply because the cost per call is significantly reduced versus Alorica. It's 50% different. So It is expected that there would be cost savings, once we get through that period of the learning curve and the ramp up, and get through any, one-time transition costs.
Okay. Thank you. And hopefully I'm almost done with this. Just want to make sure I fully understand given that the amount in the proposed revenue requirement is made up of not a clearly distinguishable expense, or at least a single one, is the amount that's derived there, can you just explain what the drivers for the, absent the shift to Alorica, what the drivers for what the assumptions are, what are the known and measurable factors that are being accounted for in the revenue requirement amount?
So with respect to incremental FTEs, it's the numbers denoted here, the 14 customer service representatives and the 3 support staffs. And I think there was some testimony in the customer service panel's direct testimony at least, and I think a handful of data requests that discussed those. With respect to the outsource costs of I-Corps, we provided Appendix A to the direct testimony of the customer service panel, providing that computation, and my recollection is the primary driver of the increase is what Mr. Daniels just mentioned, the increase in credit call volume attributable to the resumption of hardship disconnects, but I'll check if
That would be correct.
Thank you. So I can see, and I can see the results of that calculation on this exhibit, right on because it shows is that the test year volume, the 179,882 calls?
That's the forecasted volume based upon pre-pandemic volume.
Okay. I understand. Thank you. And with that, I'm gonna move over to Mr. Sobolewski.
Thank you, Richard Sobolewski for the Office of Consumer Counsel. My questions are on the credit card fees. I had some discussion with the revenue requirements panel, and they recommended that I carry forward the subject matter to this panel. So let's give it a shot. My understanding is as a result of the company's last rate case, both companies' last rate cases, CNG and Southern, the fee-free approach was put into place. Is that correct?
Could you restate that?
After the last rate cases for both CNG and SCG, the fee-free program for credit card fees was put into place. Is that correct?
The fee-free program has been in place for a number of years and a few rate cases passed.
Okay. And the approach that we have here for this rate case is we're estimating a revenue requirement for the ongoing level of credit card use plus an amortization of a deferred amount from since the last rate case. Is that correct?
Yes.
For the various customer classes, is it the same program or is there some limitation on the usage for larger business customers?
There is no current limitation. Both residential and commercial customers can use the fee-free program.
Okay. There isn't a maximum amount that a customer can put on a credit card?
No, I don't believe so.
And the fee that is charged, the company, SCG or Southern, is that based on the amount of the credit card charge, or is it just a flat fee?
The fees are the processing fee from the processing vendor, as well as the merchant bank fees. And neither of those are based on the amount of the payment.
So it's a flat amount that you charge per
Well, I don't,
transaction?
the Kubra fees are a specific amount. The merchant bank fees are not they're not exactly the same because it's based on the type of card, the card issuer, as well as whether it's like a rewards card or a different card like that, the fees vary.
Okay. And you have both looking at late file exhibit 6, which shows for CNG shows the charges on a monthly basis for the various vendors. There's an attachment 1 that shows the volume of calls, and then Payment Tech, Kubra. And those are the ones where it's those two are the processing companies, and Payguard's something different, correct?
Yeah, correct. Kubra processes the credit card payments, and then Payment Tech is the merchant bank
Okay.
fees. And Payguard is a service provided by Kubra.
Now, for calculating the rate year level of expense, yesterday I was referred to the response to Pura 002 attachment 1. And I was trying to understand exactly how this was calculated moving forward. Did you start with a base in the test year, 2022, or is it purely something forecasted going forward?
My recollection, subject to check, was the test year plus a percentage assumed incremental volume, as well as a percentage assuming a potential increase in fee. I think we can probably double check those. I think
I think there was a 1% increase in volume.
yes, and then a 1.75% increase in fee.
Okay, thank you.
Yes.
That's what I thought it was.
Yes.
But it's not tied to the amount of the bill. So if someone has a $500 bill versus a $200 bill, you're charged the same amount by Kubra?
That's correct.
Going forward, as a result of this rate case, you have these forecasted expenses for the rate year. You're also requesting an annual reconciliation of the actual expense to that allowed, with the difference being treated as a regulatory asset or liability. Is that correct?
Yes.
Okay, thank you. That's all I have.
Thank you. I know it's lunchtime. I have a couple follow-ups. Sorry, on what I was asking about before, 148, attachment 1 revised. Mr. Daniels, we were talking about the unknown factor for the shift to Alorica being the handling time and the other factors you discussed. But I also noticed after I passed the microphone to Mr. Sobolewski that there's also a difference in incremental FTEs and FTE support staff for that final option. Can you explain why there's a difference between the filing there and the last and the credit shift to Alorica?
Yes, so the company's initial filing and updated filing reflect cost associated for incremental internal FTE associated with insourcing 35% of the calls. Regardless of the scenario as depicted in LFE 148, each scenario would require incremental internal FTE because of the increased workload driven by lengthier calls.
Thanks. And yeah, I understood that the last line, the transition credit calls from iCore to Alorica requests incremental FTEs. I was more asking in the line of the last questions I was asking about sort of what's the difference? There's the model that's reflected in LFE 1 of the company's kind of final revenue requirement request. And then there's this last line, which as I was asking about before, seems to be the trying to capture what the plan, what the company expects to actually do. And then we had the conversation about that the final cost of that plan, the 1.801 million, is not yet known and measurable. And I understood that the reason for that was that the company's substituting the current call time and other factors from iCore, plugging them in using the Alorica cost. So I understood that, but what I was confused by is why there's a difference. As I understand this exhibit, LFE 1 includes a request for 14 incremental SCRs, whereas the transition line here includes 13. So is there a reason why the 13 SCR number is not known and measurable?
No, it's definitely known and measurable because it's based upon the current workload and volume being handled by these resources who are already doing that work, as well as the most recent and volume or handle time trends. So absolutely based upon mathematical calculation that accounts for the workload, which is the amount of calls and how long they take, as well as other known factors such as shrinkage, which would be combination of attendance and other off the phone needs, which are based upon historical actuals.
Thank you. And again, I'm not trying to question why the company's asking for more employees. What I'm asking about is that as of right now and out in late file 1, the company's asking for 14 more employees. But according to this model, the company expects to only need 13 more employees given if it goes with the transition calls from iCore to Alorica. So given that is the plan, I don't understand why the company is still asking for 14 incremental employees if this exhibit suggests that it's only going to need 13 incremental employees.
So the reason why there's a difference of for CNG 1 FTE is because there was offsetting cost by outsourcing additional calls, the service related calls to iCore to mitigate what would have been required, which is 26 FTE. If you'll look at line 14, which proposes 35% insource without any additional outsourcing offsetting costs.
Thank you. I guess I'm still just a little confused because my understanding of the company updated filing line item on this exhibit is that this represents the best known and measurable information about what the cost the companies will have to incur for these customer service costs in the rate year. And we discussed that the reason that there's a difference between that ultimate 2.8 million to 2.86 million and the 1.8 million that's reflected on the last line here, what's driving that is as I said before, the unknown of how much of what the Alorica costs will actually be. But I don't understand, I understand that, but what I don't understand is why there's a difference. Maybe Mr. Hurwitz might understand what I'm asking. I don't understand why there's a difference in the expected number of CSR, in-house CSRs, between what's being requested now, given that the plan is to do this shift to Alorica, and what's reflected in the plan to shift to Alorica line.
I guess I'll take a start, and Mr. Hurwitz can jump in if needed, but in the company's original proposal, but what's not reflected in the revenue requirement was a plan to outsource service-related calls. We have not, similar to the Alorica calls transit, or the credit calls transitioning from ICOR to Alorica, we had not done that before. So we didn't have a known and measurable standard for assuming what those costs would be to include them in the filing. What we did know was the cost of ICOR to handle credit and collections calls, and what's included is the amount of calls at the cost that we're currently paying for those calls to ICOR, and that's what was included in the revenue requirement.
Okay. Did you have anything to add, Ms. Hurwitz?
I could try to explain further if you're still twisted around.
I am a little twisting around because I guess I'm just not sure I still understand where the extra as compared to the difference between the 13 and the 14.
Let me give this a try, and then I'll ask Mr. Daniels to correct or add if necessary. And I'm going to start by not answering your question and instead focusing on the row directly under company updated filing labeled volume and AHT trends, which, as I understand, is a row that provides our estimated cost of no change in outsourcing. And as shown there, even if there were no change in our approach to insourcing and outsourcing, in our view, we would need an extra 13 customer service reps and 1.5 support staff just because calls are taking longer. However, in our initial filing and also in our updated filing, we did make some proposals around insourcing and outsourcing. And as Mr. Daniels described in our revenue requirement, we, for revenue requirement purposes, assumed all outsourced credit costs, all credit and collection calls stay with ICOR. So we have the full 1.873 million in ICOR costs there. However, what I understand would happen is based on, the name of the scenario is really 35% of that ICOR cost would go away because that gets insourced. But also we would gain 693,000 in outsourced service call volume. And we didn't reflect either the put or the take in our proposed revenue requirement, but they would operationally happen. However, in the final row, the one you're questioning, my understanding is that is more analogous not to the company updated filing line with the 14 and the 3, but rather it's more analogous to the row directly below where there's no change in outsourcing strategy. We need more incremental FTEs because our calls take longer. It's just the outsource vendor is changing. So that's a long-winded explanation, but hopefully that helps shed a little bit of light on what's going on here. And so I guess to just more succinctly answer your question, the difference in the incremental FTEs between those two rows is because there's a different outsourcing philosophy reflected between the two of them. Maybe philosophy is not the right word. Outsourcing, approach.
Thank you.
And I could add to that. So really what's driving that difference is the 35% of calls that we would insource, and then in row or column M, I think the cell reference would be M13, 84,000 service related calls. The workload associated with that, right? The 35% of collections calls and the 84,000 service related calls. The difference in workload of those two costs, and one is meant to offset the other, it is 1 FTE.
Okay. Thank you. And just for the record, I don't think the filed exhibit is an Excel spreadsheet, so at least what I'm looking at from the website is a PDF, so I don't see the cell references or road numbers. Could you just point me to what you were just referencing using?
Sure, I believe I have.
There's Attorney Wheel, there's a column headed outsource service call volume ICOR, kind of in the middle-ish of the PDF.
Yep.
And in that column is the 84,000 Mr. Daniels noted.
Okay, I see it. Thank you. Thank you very much. That was up. So everyone thought they were getting lunch, but Mr. Sobolewski has one more question.
If we could turn back to lay file 6, attachment 1, I have a question on what happened in 2023. It seems the expense is significantly down for 2023 versus 2022, the test year. And 2023 has a full year of pay guard. Seems like the total expense dropped from 915,631 down to 689,503.
Yeah, so what we believe is, so PayGuard is a service that prevents aggregators from taking what would have been a checking account payment from a customer, and they work with individual banks, and they combine them into credit card payments, individual credit card payments. Those aggregators, those credit card payments tend to have higher fees associated with them as well. So you've got the combination of, taking payments that would have been checks and making them a credit card and then making them more costly because of the aggregator. So the PayGuard prevents that. And so we believe that is the impact of, because that wasn't implemented until December 2022. So we're believing that has an impact on the lower costs that we see.
Do you expect that continue going forward?
It's an excellent question. I don't think we're sure. I see the trend as well. We also know that we're adding other payment options like Google Pay and Apple Pay. So we're not sure whether that might offset some of the the decrease that we see. And I think that's why we would like to see the continuation of the reconciliation approach, so that if it's if it's more, if it's less, then you have that reconciliation mechanism. But I see your observation and understand it.
Okay, thank you. That's all I have.
Thank you. That was the last question from the OCC.
All right, thank you. We'll take our lunch break. When we return, EOE will conduct cross of this panel and we will return at 1:15.
Okay, because I can give them the rest of mine. If it's 23 through 20. It's okay. Would you like your own? I'll have it. Okay. You know what, that's my gift to you. Thank you. All right, good. So you're starting at 21. EOA. Morning. Oh, they're done. You know, then when that day I was waiting. Oh, they did finish.
She got to you before I did. I was on
Hey,
my
she was
phone
watching.
typing and there, and then I see her, well, she did use that.
I don't know. Plug it in, sir? But then I gave it to my proofreader. Proofreads. Yeah. I give it to her and she was. Now then I have. I see how you're doing it and interact with you. Comes up, yeah, you, up in the beginning, you go. But there was no way I was gonna figure that out. I'm gonna do it all in college. I have my shots. And I make the first set of two, and then in the following, that's the second set of two. So I don't know why.
Had it, if you had. You're now you're reminding me actually. Very.
Right, keeps you.
That's.
Yeah, I mean, I do too. I'm so like that. Like I have my own company, Cass. Cover for Brenda a lot, and I'll do work for Brenda. Own company, you know what I mean? So I have my own company. I'm completely freelance. Oh, yeah, Dolores Balzerano. Yeah, we cover for Dolores. I'm gonna have my Dolores. One contractor contract now. Brenda.
Friday, give you a color copy, you got a color.
Oh, I don't.
Oh, I
need a
get
copy. Thank you.
Depends which printer we're using.
Yeah, I appreciate you running that.
Take care, have a good day.
Yeah. What's something like?
And I did actually just put it in for.
So.
The high one, I use the tall chair.
You do,
Actually-
all right.
I actually-
Oh, that's you, huh?
I jack this thing all the way up and I alternate between stand.
Want me to put this here like this?
I'll take care of
Okay.
Or-
I will, Brenda will get my.
Thank you.
Please expand. Okay. Oh. Another minute. Okay, anything before we resume cross?
No, we have no administrative matters.
Great, then let's resume cross for this panel by EOE, please.
Good afternoon. I'm Kim White with EOE. I'm joined by Attorney Brittany Wyman and Mr. Parent. I'm sure you're familiar with all of us by now. So I have a quick question, follow up to some of the cross that OCC had on LFE 148. Just want to make sure y'all still have it up. In that LFE, there's a second tab that says Alorica costs. And on the left side, it says ICOR, basically it's ICOR costs, and on the right side, it has Alorica costs. The Alorica costs that are in that tab, from where did you get the information to populate that tab?
So what is on the left side of the tab was submitted as a work paper to support the revenue requirement on the right side, we replicated that effort and changed the cost structure to reflect Alorica's cost structure. And then use the higher volume forecast to come up with the total cost.
Okay, say Alorica's cost structure.
Assuming their cost per or minute rate multiplied times the expected AHT of, in this case, 12.75 minutes for English calls and 12 minutes for Spanish calls.
Understood. And their cost per minute rate. I guess where I'm tripping up is 149 asked for the scope of work and the amendment letter with Alorica, and you said you didn't have that yet. From where are you getting the cost per minute rate?
So that would be an estimate. So this isn't amended. This isn't an amended, what's being requested in the statement of work and, the contract amendment. This is an estimate based upon what we know now as the cost per minute rate, as well as what we expect the handle time to be if it were the same as ICOR.
Okay, so you're saying you know that to be the cost per minute rate now, and you're based upon the average handling time from ICOR, you're incorporating that into the cost per minute rate that you know for Alorica.
Correct.
Okay. And just one quick question, the average handle time, I thought I heard something in the exchange with Attorney Will about that increasing, but it looks to me, I thought you had already increased it for Alorica at one point in time. So the increase that had, I'm sorry, I misspoke. I thought you had already increased it for ICOR at one point in time. So it looks to me like the ICOR call handle time is the same for the Alorica call handle time in here. So it already incorporated it and you just fed it through. Does that make sense?
Correct.
Okay. So where are you in the process of transitioning the calls to Alorica? 149, as you said, you didn't have the letter to provide in response to that late file request. Where does that currently stand?
Yeah,
speak to that.
Answer that question.
Our first class will actually start on Monday, this coming Monday. And we're looking for the total transition to take us through September.
So when you say that the total transition, does that mean in September, the calls will be totally transferred to Alorica? Is that what you mean by total transition?
Correct. And that's best case scenario. So we will adjust for any issues that come up.
Okay. So as of September, ICOR would not have any more credit and collections calls, and Alorica would have
Correct.
all of those calls, some number of those calls, but depending on the scenarios that were in the other.
ICOR wouldn't have any.
Got it. Perfect. Okay. Okay. Now I'm going to refer you to LFE 151. So in that response, you provided some material as an attachment to the LFE. And then the LFE in the written response referred us to some other material in the docket. Is all of the material, the attachment and the material referred to in the written response, is that what is being used to train Alorica during the training sessions, or is it just the attachments? I was having a little bit of trouble understanding.
I just might need a second.
Yeah,
to
one moment.
Review that.
No problem.
Thank you.
It's both.
Okay. Okay, thank you. And on that, in that same one, in attachment 6, page 2, I don't know if you necessarily need to go there, but that's from where my question is arising. It states about are there still CSRs that are performing the DSS opt-in process, even though we're doing the DSS opt-out now?
They're no longer using the opt-in script.
Okay, so none of the CSRs are doing that anymore then?
Correct.
Okay, so that attachment's not up to date?
It has not been revised to reflect the removal of the DSS consent requirement.
If the script has not yet been revised, how did you notify all the CSRs to no longer be using that portion?
Yes, there was an email communication that was sent to I-Court to notify them that they no longer were required to offer DSS consent.
Thank you. I guess that leads me to the question, are there any other parts of those scripts that aren't revised? Because it sounds as if the script is not completely up to date. It's at least has something in it that's not supposed to be there. So are there any other parts that aren't up to date?
Subject to tech, I believe that's the only part of the script that has not been updated. I believe we made the required changes for, at least on the electric side, for RRES and ESS, as well as the additional components in terms of references to other resources within that script.
Thank you. So now I'm turning to 154, LFE 154. You're ready. Oh.
Yes.
In that late file exhibit, we were looking for the currently used CSR call script, and it looks to me like what we got was an excerpt from it. So is LFE 151 the currently used CSR call script?
Yes, it is.
Thank you. Okay. Sorry to keep jumping around. I'm going to LFE 159 now.
Just want to clarify that although LFB 151, that attachment may be the current call script, there was notification given as far as the removal of the DSS component. Just want to make sure we're clear on that.
I understand. Yes, sir. Okay. I'm sorry, 159, LFE 159?
I have it up.
So in this one, you describe the way your speech analytics work, your analytics system works, and I'm going to probably very poorly paraphrase this here with my rough understanding of it, based that you program words or phrases into the system, and then you test it to make sure it picks up those words and phrases?
Correct.
Was that description of your internal speech analytics system or the external vendor system?
That's our internal.
I can say though that most speech analytics tools do work that way.
And then in your internal system, do you know how many words or phrases you've currently programmed into it?
Yeah, we're still in the initial stages of plugging in topics. I think we're at about 100 right now. I'd have to clarify that though.
Okay. And what, Mr. Daniels, spoke about the vendors. Do you know, vendor being Alorica now, the only vendor that would matter, do you know about their system? How many, do they have a system like this?
They do, and we have not engaged them through an entire process of using their speech analytics tool, but we have reached out to them to engage in that process.
Okay, so do you have any idea when you might implement their speech analytics tool?
I do not. Right now, we're reaching out to them on a one-off basis based on topics that come up and that we want them to take a look at. So we're still in the early stages, but we'll know more on that as we get through these first few topics with them.
Just to clarify, there are two separate speech analytics tools. So they have their own, Alorica has their own, and we have our own tool. So they would monitor their own calls based on coaching and feedback from us or coaching and feedback from their leadership. And then we would manage our speech analytics tool independently.
So when you say for your speech analytics tool, though, it is applicable to your in-house CSRs, and their tool is applicable to their CSRs handling the calls for you.
That is correct.
Understood. So for your system, I presume the answer to this is that it's a little nascent at the moment, but are you currently running any reports on it, or is it not to that stage yet?
We're not really at that stage yet.
Okay. I'm going to hand you over to Mr. Parent for a minute.
Good afternoon, panel. When Attorney White referenced minute, I'm actually pretty optimistic. I'm going to generally refer you to LFE 144.
Okay.
During the hearings, there was some discussion regarding the FIFI program. The LFE response provides a timeline to move non-residential customers from the FIFI program to the customer paid model. Has the company provided somewhere a breakdown of the actual costs between residential and non in interrogatory response, something that specifically breaks down the costs? If so, where?
The costs of just the fee-free program in general, or?
How it's applicable to residential customers versus non-residential customers. So if we looked at the total amount of the costs since the inception, how much is applicable to the two categories?
Yeah, the program has always been applicable to both residential and commercial, so we don't have data splitting the cost of residential versus the cost of commercial, to my knowledge.
I'm sorry. Apologize for interrupting. So, do you know when the program began?
I believe 2008 potentially for one of the companies, and possibly before that for one of the others, I think, when we did the research, but it's been, a number of years, at least 15 years.
So a few rate cases back.
Yes, a few rate cases back.
Okay, and when it was originally it was approved by the authority back in some original rate case then?
Yes.
Okay, thank you.
I did ask a question. I didn't quite, was that the answer is there's no breakdown of the costs that's on the record?
Not to my knowledge. I know all of the costs that we provided included all customers who used the credit card. I think there might have been a interrogatory where we did a small sampling of the number of residential versus commercial. I think it was like maybe 10%
So
commercial from my recollection.
RRU RRU 665 actually provides a breakdown of volume. It's not cost, it's volume.
Okay.
If one wanted to determine the allocation between residential and non-residential, is that the basis for the allocation? Meaning, if I ran the numbers, 40,304 for residential for 2020, 2,037, about 4%, would I use that as the benchmark to allocate the costs? Would that be a fair proxy?
One moment. I mean, if what you're suggesting is we take like the average is 4% of the customers are commercial and then we do the costs, split the costs that way?
Would that be a fair proxy?
Yes, you would, because the costs are the same, so we would just take
Okay.
a percentage of the cost and assume that would be non-residential.
For CNG, so RRU 665 provides 20 through 23. It doesn't provide 2019. And the FIFI programs from the prior rate case was applicable to 2019. Would it be fair to use the same percentage from 2020 as a proxy for 2019 as well?
Just give me a moment. I want to bring out, it's RRU.
RRU 665.
Yeah, so your suggestion is to take the percentage difference as reflected in 2020?
My question is that a fair proxy?
I mean, I suppose it could be as fair as any of them. I don't know which would be more representative, but I think that we could do that.
Okay. Thank you.
I'll add one more question because we're having a little bit of a trouble finding it in our internal system here. Do you happen to know which rate case the FIFI program was approved in? You said roughly 2008 it's been.
I don't have that available.
Would that be something you think you could get and just do as a quick read in before the end of the?
Yeah, we believe it's in the record. We think there's a discovery response on it, so.
May have been Puro 1 references docket number 081206.
Thank you very much. That's it for EOE. Thank you.
Okay, thank you. Attorney Wright? Thank you. Any questions either? Does the company need a moment to consider redirect?
Yes, please. We have just a couple things.
Okay.
Ms. Palella, you recall during cross-examination by the OCC, you had questions relating to whether there was a limit on the amount of a credit card payment that could be accepted?
Yes,
And do you have further information that you've found since that time?
yes, I clarified that there is a $10,000 limit on the amount of a payment that you can make with a credit card at any one given time.
Okay, thank you. And Mr. Drahota, you recall cross-examination on the speech analytic tools that the company is developing and what?
Yeah, and I just want to make it clear that it is our intent, our future state for internal, external, regardless of vendors, that we're fully utilizing speech analytics. We're just at the early stages with our vendor right now.
Thank you. That is all we have.
Can I ask a clarifying question, Ms. Blow, on the you said $10,000 per time?
Yeah, the question was, is there a limit to when you're making a credit card payment? Is there a limit to how much you can pay? And the
Okay.
limit is $10,000.
Okay, but the way you said it made me think you could charge it multiple times. It's just,
My understanding, it's one payment of $10,000.
okay, sorry. Do you understand my source of confusion? I didn't understand the way it was responded, whether it was today you could charge 10,000, tomorrow you could charge 10,000.
Yeah, no, I understand your question. Now that you've clarified it, to be honest, I would have to clarify that portion of it. I know that the limit is $10,000, but I don't know if you wanted to pay 10,000 today and 10,000 tomorrow, if there's a limit on that,
Sorry.
which I could probably try to find out as well.
Maybe by the next
Yeah,
redirect.
This is a CNG panel, I think, right? So we have one more time through.
Yeah, we might
yeah.
get a message between now and then.
Okay, sorry, thank you. for
No, good
answering.
question. Thank you. So with that, we're concluded with the CNG panel.
Okay, thank you. Then we can transition into the SCG panel. And I don't think authority staff have cross. So Attorney Will, you'll be up first. While he is getting settled, Attorney Venora, any new witnesses or preliminary matters?
No, all the same, and I'll simply go through the questions and have them stipulate to their testimony from the CNG portion of the hearing. So to the panel members, do you recall answering a series of questions I asked you at the start of your testimony for CNG on this topic?
Yes.
Yeah. And do you also recall answering questions on cross-examination during that portion of the hearing?
Yes.
And in appearing now for SCG and for purposes of administrative efficiency, do you adopt your testimony from the CNG transcript and stipulate that if asked those same questions again, your answers would be the same?
Yes.
Okay, thank you. That's all we have. So the panel is
you.
available for cross.
Thank you. Attorney Wheel.
Thank you. Hello again, Tom Wheel for the Office of Consumer Counsel. I have far fewer questions this time around. During the CNG panel, I asked questions related to LFE 164 pertaining to the plan to transition from I-Core to Alorica. Sorry. I think 164 might actually be this SCG equivalent.
It is.
Thank you. The SCG equivalent for the late file I was asking about for CNG is 164. Would there be any difference in the responses to those questions aside from any numerical content for the proposals that I was asking about?
There would not be.
Thank you. Mr. Sobolewski asked several questions about late file 6 for CNG, which pertains to credit card fees. The SCG equivalent of that is LFE 30. Other than the numbers that differ between LFE 6 attachment 1 and LFE 30 attachment 1, and other than Ms. Palella's redirect inclusive of Ms. Palella's redirect testimony and her responses to the chairman's questions from her redirect testimony, would any of that testimony differ, again, other than the numerical differences in those exhibits for SCG?
No, it would not differ.
Thank you. One follow-up question on that line of questioning. Mr. Sobolewski asked you missed below, I think, whether the credit card fees incurred by the company are dependent on the size of the transaction. And I think the response was that the company incurs a flat fee, whether the payment's $20 or $50. Is that correct?
The flat fee from the Kubra payment processing aspect, but the merchant fees can change based on the type of card that they're using.
Okay. But do they change based on the size of the?
No, not based on the size of the payment amount.
Okay, thank you. And I heard on your redirect testimony that there is a $10,000 limit. So just to be clear, there is no change in a particular merchant fee, for instance, as between a $20 charge and a $10,000 charge, it would be this exact same fee.
Correct.
Thank you. With that, OCC has no further questions.
Thank you. EOE, please.
Hello again, Kim White from EOE. This is going to be relatively quick, hopefully. Just first off, we'll do the usual stipulation. A few moments ago, EOE Attorney Wyman, Mr. Perrin, and myself asked the CNG panel a series of questions. In lieu of repeating each question, I'm re-asking those questions for the record now and request that SCG stipulate that it answers each question the same as it did in the CNG portion of the proceeding. Do you so stipulate?
Yes.
Yes.
Thank you. I just have two quick questions specific to the SCG panel. Let's see, so in Read-In LL, you stated that what you paid ICOR for the SCG hardship documentation. So going back, my understanding was that CNG reviewed its own hardship documentation and SCG had ICOR do it for them. And you referred us to page 6 of the contract amendment or the contract in EOE 308. That contract was dated July 31st, 2022, whereas the contract that was provided in the response to EOE 262 attachment 1 was dated January 1st, 2023. So was EOE 262 the price that is the current price?
Yeah, and I don't think we made any changes to the amendment when in July of 2023. So if you're looking at I know the dollar amount, but I think you're looking at the incorrect number. Yes, if you add $10 to that, that's about the correct amount. Does that make sense? The hourly.
I had $10 to the amount in EOE 308 or EOE 262.
I'll have to take a look. 262.
Okay.
Yes, yes.
Oh, so 262 was the later, 260.
No, then I'm sorry, the
Okay.
latter one. Yes. 308.
Okay. So I'm gonna repeat that back just to make sure we're on the same page. EOE 262 attachment 1 is dated January 1st, 2023. You think that in July of 2023, the amount in EOE 262 attachment 1 was increased by roughly $10?
Correct.
Okay. Is that amendment in the record somewhere?
There's a pricing amendment for ICOR that I don't believe impacted the dollar amount. I just mentioned it as there was a the July 2023. There was a contract for ICOR signed in May, and then we did the pricing in July.
I'm sorry. This is unfortunately getting more confusing for me. EOE 262 had asked for the most recent contract at that time. And we were given a contract that was dated January 1st, 2023. Are you telling me there were contract amendments and terms and things that happened after January 1st, 2023? Okay.
So the document or the contract that I'm looking at is the one that was signed on May 1st, 2023. It's 262 attachment 1. Page 9 has the date it was signed.
Gotcha. Okay, and so I think that returns us back to where we said it originally. 262 was the most updated version of the contract. Okay, and so I think that might correspond better with what you were saying, because 262, the pricing in that is roughly $10 more than what it was in 308. So you're saying, so the pricing in 262 is the correct
Yes.
price? Okay.
For the pricing there, you have not the cost, but the label is just SCG medical hardship. Is that pertaining to both hardship documentation processing or medical processing, or medical and hardship processing?
Attorney Wyman, you said is there a particular
Oh,
page
excuse
or
me.
portion of the document you're referencing?
It's page 60, where the costs are noted.
Correct. It's both.
Okay, thank you.
Okay, just one more question. This one might actually belong to the rate design panel, so let me know, but the individual sponsoring the LFE were on both panels, so I just wanted to try here. In LFE 152, you stated that you corrected the billing error and gave the customer approximately $12,000 credit. Do you know the date on which you provided that to the customer?
Yeah, I believe it's included. It was recently that we provided the credit to the customer.
Um,
I'm just looking to see if it's in the response. So we did a correction from the bill that was serviced through April of 2024, which resulted in the credit of $12,000, which then resulted in the customer's remaining balance of $4,425 because they had made very few payments since they moved in 2022 and had been under hardship protection throughout the pandemic.
Okay, so then the credit would have flowed through on their May bill.
Yes.
The bill resulting from their May meter read.
Yes.
Okay. Thank you very much. That's it for EOE.
Thank you, Attorney Wright. Thank you, Commissioner. I don't have any questions, and unless the company has been able to clarify the $10,000, that's it for me.
I have a tentative answer of they believe you can pay 10,000 today and then 10,000 tomorrow, but they haven't been able to validate it completely.
Okay, all right, thank you. Then Attorney Venora, do you need time to consider redirect?
No, thank you. We have no redirect.
Okay, thank you. Then we can excuse this panel and transition into SCG's environmental remediation panel. And the OCC is up first for cross-examination.
Okay. Chair Gillette, while we transition panels, I do have one administrative matter to raise.
Yes.
So yesterday afternoon, there were some questions by OCC to the gas operations panel that related to LFE 68 and the counterpart answer SCG LFE 75. That was the unregistered meter report. And Attorney Wheel asked a number of questions about, the details on how to read that report. We've since determined that there's some additional information that would provide greater clarity on the answers we provided yesterday. And so my request would be if we could do a supplement to that response. We didn't pick it up until this afternoon that there was a potential discrepancy in the testimony that we provided.
Okay, is the witness here?
Yeah, I mean, we could have Mr. Langland and Mr. Romero address it on the stand. I wanted to make sure we, stayed with your procedure, but we can do that.
Yeah, the reason I would suggest doing it on the stand, if I'm understanding correctly, there may be the possibility of clarifying questions on the information.
Yeah.
So, do we want to ask Mr. Langland and Mr. Romero to come after this panel and supplement their testimony, and assuming Attorney Wheel's still sitting there, can ask any clarifying questions?
Sure, we appreciate that. Thank you.
Okay, thank you. So for now, we'll take up the environmental remediation panel. Believe it's our same two witnesses. Correct?
Yes,
Anyway,
yes,
or
same
three
witnesses.
excuse me.
Yes, everybody's been previously sworn. And so Mr. Mullen and Mr. Burgess, I'll ask you, as part of your preparation for today's hearing, did each of you sponsor or co-sponsor certain responses to late filed exhibit requests issued during the hearing?
Yes.
Yes. And do you have any corrections or clarifications to any of your late filed exhibits?
I do not.
No.
And do you adopt them as part of your sworn testimony in this case?
Yes.
Yes.
Okay, thank you. The panel is available for cross.
Thank you, Attorney Wheel.
Thank you. Good afternoon, Tom Wheel for the Office of Consumer Counsel. I have some questions starting with LFE 183, attachment 1.
I have it open.
Thanks. Starting with page 22. It looks like there was a phase 1 investigation at this site in 1991 and a phase 2 in 1993. And on page 24, I also saw, it looked like I couldn't tell whether there was a full phase 3 in 1999 or whether that was just initiated. So my question is, those dates predated the company's tenancy at the site, is that correct?
I hesitate on the phase 2, phase 3 part, but I know the initial phase 1 that you referenced in 1991, that would predate, but we're not exactly sure when the company first occupied the exact month.
Okay, but it was after 1991?
I believe so.
Okay. And these phase 1s, 2 and 3, those are all pertaining to the same contamination, is that correct? The ones on the dates that I've mentioned. So the phase 1 in 91, phase 2 in 93, and phase 3 in 99.
I think without looking at those reports in detail, it'd be difficult to say that they pertain to the same contamination, but they do pertain to site assessment and investigation of the property.
Okay. Are you aware whether a phase 2 investigation follows a phase 1 assessment typically?
Typically, yes.
Okay. So did Saab or whoever was previously occupying the property contaminate it prior to the company taking tenancy?
Again, I'd have to go back and look at these reports in detail and the timing of occupation of the company occupying the property, the two different companies. It would be probably difficult to tell, just given the nature of some overlapping in operations and activities, some similarities.
Okay. Thank you. On page 27 of the same attachment, there's a reference to listed as AOC number 3 there, gasoline and diesel underground storage tanks. And on this attachment, it says of unknown date and duration, uncertain reported releases. It looks like there was a phase 1 assessment and a phase 2 investigation, and it says investigation ongoing. Do you know what the status of that investigation is?
Sorry, could you just point me to the line?
Sure, it's page 27. And there's kind of a table there. So I'm looking at the number 3 on the table.
That phase 2 investigation has been complete.
Do you know whether those storage tanks are still there? Or if they've been removed?
To my knowledge, the storage tanks on the property have been removed.
Okay. And do you know whether there was any soil contamination or groundwater contamination discovered in that investigation?
For that specific area of concern, I'm not sure what the findings were. I'd have to look into the detail of the report.
Okay. Thank you. And the same page, the 10th item there, says oil water separator, trench drain, and exterior waste oil AST. AST stands for above ground storage tank, correct?
Correct.
And do you know the status of that investigation?
The investigation for those, for that area of concern is also substantially complete. And that oil water separator that's referenced has been removed.
Okay. And I noticed on that page, the date and duration says 1990s through present. Do you know whether that trench drain and separator was there when the company took occupancy subject to the lease?
I'm not aware of that detail.
Thanks. On page 29, also on row 10, it looks like soil samples were taken for that area of the site. Is that accurate?
Yes.
And on page 41, is that the results of the testing of those soil samples?
So the section you referenced, the results that are summarized for AOC 10, it appears those are, it's a summary of results for soil samples analyzed from that area of concern, but are they those specific samples? I'm not sure. I'd have to go back and look at the details.
Okay, thanks. And it looks like those results include positive detection of a number of SVOCs, and that stands for semi-volatile organic chemicals. Is that right?
Yes.
So was that soil remediated underneath that oil and water separator?
I'm not sure. I'd have to look at the remedial action report that was performed for the property to see if this area was included.
Okay. Going back to page 39, there's also soil sample results there from the former interior trench drain. Do you know if that, those samples found VOCs, which are volatile organic chemicals, is that correct?
Looking at the summary, it does, I do see some VOCs, some compounds that are subsets of the VOC analysis.
Thank you. Do you know whether that soil was remediated?
I just want to clarify, I'm not sure. Well, first, without comparing these results to the remediation standards, I would have to go back and check to verify whether they were required to be remediated or not. But then the question of were they remediated? Are you getting at like physical removal, some type of excavation activity?
Possibly. I guess my question is just whether the company ever had incurred any expense to resolve the contaminations of in these areas. So whether that's dredging or horizontal drilling or whatever deep ultimately wanted the company to do. I'm not sure. I guess that's the basis of my question, is like whether anything ever happened as a result of these testing results.
So looking at the detail provided on this line for this area of concern, I don't believe there was physical remediation, and I'm not, looking at these results, I'm not sure without checking the details if some remediation is required. It may also be in the remedial action plan to address it with an environmental use restriction or an administrative control.
Okay, thank you. Are any of the proposed costs to be incurred in the rate year related to remediation of, well, I'll back up. Are there testing results or other results included in this attachment that are related to the remediation costs that are proposed to be incurred in the rate year?
So the projected cost for the rate year, some of that is, or the majority of that is to continue to monitor the hydraulic oil release in the maintenance garage, which would be area of concern number 1.
Thank you. So the company's that not going to incur costs related to any of the other areas of concern on this exhibit?
I'm just checking our projection and the activities that are projected in the schedule. So looking at LFE 188, we have we've outlined some general tasks that for the rate year. And some of those include general reporting and groundwater monitoring. So they could be for the larger site and not just focused on that area of concern.
Okay, thanks. One last question on this exhibit. Going back to page 20. Just the site history here. There's a line here, it's like the third paragraph down, it says from 1991 to 1994, the site was vacant. And then after that, it says from January 1994 to present, SCG has occupied the site. Is that accurate? I'm just a little confused because it sounded like you weren't sure whether, I think I had asked about a 1993 report and you weren't sure whether the company was occupying it at that year.
To my memory, I thought the lease began somewhere in the 1993 to 1994 range when the company started occupying the property. I wasn't sure what the exact month was of when SCG started occupying.
Okay. Do you have any reason to believe that the statement here that says from January 1994 to present, the Southern Connecticut Gas Company has occupied the site is not accurate?
I don't.
Thank you. I'm going to move on to LFE 185, attachment 1.
We're here.
Thanks. I guess I could have asked this question without asking you to open it. Just to confirm, is this the full incurred environmental remediation expense in the test year for the Marsh Hill Road site?
That's correct. Attachment 3 includes 2022 and 2023.
Yeah, that was going to be my next question. Is it looked to me, just wanted to make sure I was reading this right. It looked to me like the company was invoiced $2,500 on December 20th, 2022 for that very last line item. And I assume that that's the $2,500 reflected on the 2023 total. Is that just because that was paid, like the company incurred that, they paid that invoice at some 11 days after at some point that incurring it in December of 2022?
Yeah, that's correct. What we tried to do was show the date of the invoice and then it was actually posted and paid.
Okay.
Posted for payment.
Thank you. So yeah, that was the reason I asked. So this represents, I was a little just confused by those the two lines at the bottom that say 2022 total and 2023 total, with 2022 being the test year. But is that, I assume the $2,500 is included as a test year expense because it was the expense, the services for which the expense was paying were performed in the test year. Is that accurate?
I don't think so. We've identified in the test year, the expenses that were posted, for payment.
Okay. So then the 2022, the test year incurred expense for this site then would be that $13,847 number?
That's correct, and that's fairly close to, I believe it's OCC 264. Yeah, OCC 264 shows an expense of $13,000.
Okay. Thank you. Gonna go to LFE 186 attachment 1.
Okay.
Then all the way down to page 214. There are a number of these Comcast bills throughout this exhibit, and it looks like these were bills issued to Haley and Aldrich. And then I think I see them reflected on the bills from Haley and Aldrich back to SCG. Like it looks like this one appears on page 219. Is that accurate?
I'm not at that page yet.
Sure.
Okay, I've got the document open now. Which page was that, the first one you referenced?
Sure. It was 214 is a Comcast bill for $225.18. And then on page 219, and sorry, just to be clear, as I read that, that's a bill that was issued to Haley and Aldrich, not to SCG. You with me so far on page 214?
PDF page 214, right? Oh, this is.
Yeah, on my PDF, it's the same, the labeled
I'm
page
sorry.
number.
Let me make yours, Bill. Yeah, that's correct.
Okay.
Agree with that.
So when we see these throughout this exhibit, were these backup that were provided to the company with the Haley and Aldrich invoices that reflect matching expenses on their line items?
That's correct.
Okay. So like if I go to page 219, maybe 2/3 of the way through that invoice, I see a Comcast line item for $225.18. And it looks like it's the same invoice date. So that's where that shows up, where the company has to pay that bill. Is that correct?
That would be correct.
Okay. And is this part of the contract with Haley and Aldrich? The company's paying is this for like internet at the site?
Yeah, on the site, there'd be a support trailer with internet connection, safety, eye wash stations, so forth. So this was a part of that, so we could connect and data exchange.
Okay. Is there any particular reason why that bill isn't just billed directly to the company as opposed to through to the vendor and then passed directly through to the company?
I think it's pretty easy if there's an issue that the contractor can manage directly and that they're responsible for that. So we prefer them to just coordinate it all, take the responsibility for the maintenance of it, and making sure it's working for them.
Okay. On that same page, 219, the second to last line item there is for $1,068.24 for display ports, USB-C docks, monitors, and a wireless mouse. So were those purchases that Haley and Aldrich made that it's billing to the company?
That's correct.
And does Haley and Aldrich retain that hardware?
Nope, they would provide it back at the end of the project, end of its use.
Okay, and do you know if that gets rate-based? Like, would that be the company's assets?
I don't know that detail, how that works at that level.
Okay.
No, we would take it, use it at the construction site. You can imagine construction sites are pretty dirty and dusty. They'd just be an expense of the project.
Thanks. Do you know if any of the capital assets that are owned by the company at this site that are there for the purposes of remediation are in rate base?
I don't know that specifically, but I'm not sure of many. I'm not well versed on the capital assets. Most of this is consulting services, professional services, drilling services. We do get waste disposal services, and they'll drop a dumpster. We have the internet like this, a rental construction trailer for office use.
Thanks. And the reason I'm asking, although it's a very small amount of money, is that I guess the reason for the question is that if this is being if the Haley and Aldrich is being compensated for this as part of this bill, then it's being expensed. But if part of this bill results in capital assets owned by the company and that enters rate base, then that's potentially double recovery. So that's, Mr. Hurwitz, maybe do you have any idea of whether there are any rate base items that would have been kind of expensed through a vendor?
I'm trying to track down that answer. I suspect there's a materiality threshold for capitalization that this $1,000 expense probably does not meet, but
yes, I understand. My question was more in principle, using this as an example. I mean, of the 463-page exhibit, it was just sort of in principle. Is it possible that that's occurred for any item?
Our intention is not to seek double recovery for any amount. I'm just trying to track down the exact accounting for how this may have been handled.
Thanks.
We're pretty confident the answer is no. There's not double recovery. Just as a conceptual matter, we'll capitalize amounts based on our original cost for that asset. And based on how this is invoiced to us, that this wouldn't count as an original cost that we would use to capitalize something on our books.
Understood. So this would likely come to the company and flow through expense, and there wouldn't be anything to kind of catch it as recognizing it as an asset after that point. Is that fair?
In effect, that's right.
Okay. Thank you. This is another relatively immaterial question, but on page 222, we were just looking at page 219, and page 222 appears to be it's a different kind of format, but it appears to be the exact same bill as on page 219. But there is kind of if you scroll up to like page 220, there's sort of a break in between those documents. So I'm just making sure, was this a double bill, or was this kind of part of the same bill on page 219?
I'll see if I understand your question. There are breaks in these invoices from page to page. There's some blank white space, but also occasionally as the invoice gets scanned in, they get out of order too. You probably may have noticed that. So what we tried to do was put a page break in between each invoice. So Anything between those page breaks would be one invoice, be on the same invoice.
Okay, thank you. I did see those page breaks. So given that this bill on page 222 was likely provided in the same, as part of the same invoice on page 219, it wasn't paid twice. Is that correct? And for clarification, there are no of those page breaks between those pages, which is why I assume that they are all part of the same.
Yeah, I'm pretty sure that that was only paid once. I think what you're seeing there is that the total, so it's page 221, shows the 4,981 and 81 cents. I think that's the total invoice amount. So that's what would have been paid.
Okay, and then page 220, I do say it says billing backup. So is that just, would have been likely included and it's just repeating, it's just showing a line item breakdown of that total?
That could have been, sure.
Okay.
I'll agree to that.
And just to be clear, the reason I'm asking is, again, page 219 also shows a line item breakdown, but this is only, it's less than $5,000, so I'm just asking for clarification. But I understand, thank you, that I appreciate the significance of the page breaks that were added to the exhibit. Last question on this one, throughout, similar to the Comcast bills, there are line items on the Haley and Aldrich invoices for United Illuminating. For example, there's one on page 356. And I assume that's for the electricity Haley and Aldrich is using at that trailer on the site. Is that accurate?
That's correct.
Okay. And is the reason for that not being direct billed to the company for the same reason you described for the Comcast?
Correct. We would ask our vendor to secure the services they needed to facilitate their work.
Thank you. I'm going to move on to LFE 187, please.
Okay, where we're there.
Thanks. On page 19, I just noticed that this invoice was addressed to the accounts payable at the United Illuminating Company rather than SCG. Do you know why that is?
I do not know. I'll suspect it's just an error.
Okay. But can you confirm that this is an invoice that was incurred as part of this remediation site?
Yeah, that service, they did a bunch of document management, reviewing old historical files and arranging them for us.
Okay, and those files were specific to the remediation issue for SCG?
That is my understanding.
Thanks. On page 26, looks like this is another invoice that may have been submitted to Haley and Aldrich and passed through to the company. I was just curious what this, I was trying to read the in-house mobilization towing mileage. Just curious, do you know what this invoice was for?
The invoice is for a subcontractor who facilitates that sampling and sediments for the Mill River. I'm having a little bit of hard time seeing the actual detail on the invoice, so if you bear with me.
Sure.
Okay, and your question again, I can see it a little bit better now.
It was just, you were beginning to answer it very well. It was just, I was just wondering what the service that was being billed here was. It sounds, I'll let you describe it again.
Yeah, TG&B is a vendor who provides services to collect samples in river environments. In this particular instance, they provided service for investigations in the Mill River.
Okay. Thank you. I noticed, I apologize for how tedious these questions are, but we are the Office of Consumer Counsel. So we like looking through these things. On page 171, this is again a Haley and Aldrich invoice, I believe. I noticed in several places throughout this exhibit, there's that last line that says communication fee, and here it's $521. Do you know what the communication fee is?
That's a fee that they would charge for computer services, cellular devices, things that are distinct from their labor.
Okay. Are they not passing through like a Comcast bill to the company for this site?
This is the same site. We've been on the same exhibit. This is their fees for their computer services, their actual devices that they use, that they charge for.
So it's like a fee for the use of their computers while they're on the site?
And all the associated costs in the background that go with those devices.
Okay, but not the internet connection, right? Because that's being billed.
That would have been billed through the provider of the internet service.
Okay. Thank you. I'm gonna go to LFE 188, which I think is the last exhibit I have questions on.
Okay.
On page 6, I saw that there's a $0 forecast for 2027 and beyond. And I saw the note there that it assumes that potential long-term remediation activities that required are transferred to a future property owner. I was a little confused when I saw that because I thought that at least I had spoken to a panel during the hearing that there was a shorter term plan to sell this property. Can you explain why it looks like that, at least according to this exhibit, it looks like that wouldn't come into effect until after 2027 or after?
Not having a finalized agreement, this was the assumption that we made in order to provide this cost estimate projection and summary of activities.
Okay, is there a reason that the company chose 2027 as an assumed date that they would no longer have the environmental liability?
Just with the unknowns and not having a final agreement, and we had to make some general assumptions in order to prepare this estimate. So we thought that using 2026 would be reasonable just for providing this information without having additional information at this time.
I would just add, I do recall some exchanges regarding a potential nearer term sale of this property. But I also recall some exchanges about a potential leaseback period that would follow it. And as Mr. Burgess just described, there's a lot of unknowns here. And so we had to make some assumptions to develop this forecast.
Thank you. Yeah, I appreciate that. I was wondering, it doesn't sound like this is the case, but I noticed in one of the responses regarding the Marsh Hill property, there was a discussion of how the seller had put a certain amount into escrow to cover remediation expenses for the first several years after the company had purchased it. It's in the response that discusses the historical expenses incurred since purchasing the property. So I was just wondering, this doesn't reflect a plan to similarly put some amount in escrow to cover the costs for the new seller's remediation expenses?
No, not that I'm aware.
Okay. Thank you. Page 4 of the same exhibit. I was just trying to figure out trying to tie the rate year remediation costs here, since the rate year is kind of crossing over years as we've talked about before. So, I mean, is the forecast for the rate year sort of a mixture of the 2024 and 2025 estimates reflected on page 3 to 4 here?
That would be correct.
Okay. And actually, according to the testimony, the company's seeking for the rate year and base rates $893,000, but with a proposal to defer the difference until the next rate case. Is that accurate?
That's correct.
And is that proposal, well, does the company yet know whether that proposal would be in place beyond the rate year? Meaning, if rates weren't reset beyond the rate year, obviously the 893 would still be in rates, but would the proposal be to continuously defer the excess until the next rate case?
Yes, that's correct.
Thank you.
And I'd just add that that's similar in function to the approach established in SCG's last rate case. It worked the same way.
Okay, thank you. So I mean, the reason.
Last caveat, you quoted the 893, and that was the correct number in our initial filing. We updated the inflation rate and now the 893 has become 895.
Okay, thank you. But if I was trying to get a general sense, given that proposal of with the obvious caveat that these numbers in LFE 188 are estimates and even ranges, so they're with the understanding that they're not exact. Could we get a general sense of what the company expects to book as a deferral from these numbers? In other words, by subtracting 895 from this general range, would that give us an estimate of what the company would end up deferring until the next rate case?
Attorney Wheel, I think that would be mathematically feasible. Of course, you could do some sort of midpoint and subtract the baseline and base rates and then impute the amount that would then be deferred if that became reality. I would just emphasize, this response to LFE 188 begins with a fairly lengthy list of caveats, and even these numbers here are provided as ranges. And we did that because these costs are so uncertain. And that's one of the reasons why we are proposing to continue the deferral mechanism established in the company's last rate case. And one of the reasons why we felt that the historical test year plus an inflation adjustment was the most appropriate number to put in the revenue requirement, because that to us seemed the most known and measurable. And I won't reiterate my ode to the known and measurable standard from earlier today, but this is another instance of that, where we wanted to put in the revenue requirement what we felt was known and measurable, even though there may be other estimates or projections that you could mathematically put together.
Thank you. And I appreciate all of that. I was just trying to get a sense of what we might expect in the long term based on what the company expects now to have to deal with on behalf of ratepayers when time comes due to recover the asset. But
I understand, and I think what you described would be the mathematical way that would be done.
okay. Thank you. And lastly, on page 2 of this exhibit, I don't know why I did it backwards, but it looks like the cost kind of, again, with the caveats that these are rough estimates and ranges. I was just curious, it looks like for both 2024 and 2025, the range tops out at 500,000, but the revenue request was 515. I assume that's actually been adjusted upward with the adjustment to the inflation factor.
515 has become 516.
Okay. So is there any, I guess, especially based on what we were just talking about, if the known and measurable, the best known and measurable adjustment is more like 516, is this range maybe understated in this exhibit?
I think I can answer that. As you point that out, the range was intended to be 475 to 525 to kind of cover that little bit of uncertainty that lines up with our projection more nicely. So that is simply, I'm glad you pointed that out, simply a typo there.
Okay. And even with the very minimal inflation factor adjustment, would it still be, with the top end of that range still be in the 525 range today?
As we anticipate and see the work, that would be true.
Okay. Thank you. That was my last question for this panel.
Okay, and I'm sorry to move you, Attorney Wheel, but I think us authority staff do have cross before we come back to the other matter. So I'll call up authority staff, please.
Good afternoon, Jim Buckley with Bureau staff.
Good afternoon.
Turn to late file exhibit 185, please. I'm looking at the attachments 1 through 3.
Okay.
You have this? Okay. And the purpose of this late file exhibit was to account for total 2023 remediation expense. If I go through and sum up these figures here, in each instance, I'll start with Chapel Street. The company lists 2023 expenses of $400,000. I'll compare that to what's in the Schedule C 3.04. which is $893,000. If I look at Pine Street, on page 2, attachment 2, $348,000 versus $515,000 in C 3.04. Marsh Hill Road, attachment 3, $2,500 versus $14,000 in C 3.04. So in each instance, the numbers are higher in the test year versus what the 2023 experience was. Does the company still believe that 2022 test year is the appropriate measure for going forward expense?
The short answer to your question is yes, we continue to believe the historical test year is the appropriate basis for determining the revenue requirement. And I'd note that the usage of a test year is commonplace in the computation of revenue requirements, not just in Connecticut, but in basically every jurisdiction of which I'm aware in the US. And there will be ebbs and flows year to year. If you take a step back and look at the broader historical trend, which we provided in response to OCC 264, you'll see that there are years for each site that go both directions. For Chapel Street, while our 2022 test year expense was $826,000, and the year prior, 2021, we had over 1.5 million. In 2020, we had 1 million on the nose, coincidentally. In 2019, almost 9 million. In 2018, it was less, 707,000. And similarly for Pine Street, there's been fluctuation, and for 60 Marshall Road, there's been fluctuation. So I do see your observation that 2023 is relatively lower than the historical test year for these properties. But I think when you evaluate the historical context in total, which we provided in OCC 264, and our forward-looking expectations, we continue to think that 2022 is a reasonable basis for purposes of the revenue requirement. And with respect to Chapel Street specifically, again, I'll emphasize that our proposal is to continue the deferral mechanism. So if costs do end up lower than we've put in the revenue requirement, we would return any excess collections to customers in our next rate case.
Correct, and that's the only one of these three properties where that treatment is requested.
Correct.
Okay. Recognizing what you just mentioned about the previous year's ebbs and flows, is there anything particular in 2022 or 2023 that was an anomaly compared to 2022 for these properties in terms of these expenses?
One moment. Mr. Vacalina, my apologies. You quoted a number for the 2023 expense for Chapel Street. Could you please just repeat what you had quoted?
Sure, I have $400,000, and that's the one that I had to manually calculate. You provided the others for the other two sites, so
Got it. Thank you.
subject to check.
Oh, that's helpful.
Okay.
I'll start and then I'll invite my colleagues to weigh in if they have more to add, but I think it really comes down to the nature of the work. And I think we discussed during the prior set of hearings in this proceeding that 60 Marshall Road and Pine Street are in what we might call the OM&M operation, ongoing maintenance and monitoring phase. And so I'll observe that the variation year over year, while there certainly is one, is of a much smaller magnitude than you see at Chapel Street. At Chapel Street, we're talking hundreds of thousands of dollars difference between 1.8 million, 800,000, a million, and we're projecting multiple millions into the future. Whereas for the other sites, which are in the ongoing maintenance and monitoring phase, while there is still a variance, it's of a smaller order of magnitude. I think the variance for Pine Street's on the order of 100,000, the variance for Marshall Road's on the order of 10,000. I think the cause of that variance is just the nature of the work, but I think the phase of the project has a lot to do with the magnitude of the variance, both that we've seen historically and that we would anticipate in the future.
Okay, thank you. Late file 188.
If I can just take a moment to further explain maybe what Mr. Hurd said, is that these projects do change based on conditions. If we take a look at Pine Street, the cost was a little bit lower. There could have been equipment that didn't need maintenance or repair or replacement, more of a maintenance effort. The next year, maybe we'll get some equipment that needs some repair. So it's going to change from year to year. You know, the goal is always to maintain, operate as most efficiently, but things are going to wear out and we can't always predict when that's going to be. So that's some of the variation in Chapel Street, very complex project. You know, the schedule moves based on findings and activities. So you will see these movements. It's not necessarily linear in all times.
Okay, thank you. Late file exhibit 188, concerning the deep approved investigation or remediation plans, the company for each of these sites has provided, let's see here, work plans, remedies, as well as milestone reports on each property. All the activities below here relate to the specific deep directives regarding those specific items, or each of those items that I talked about, work plans, remedies, and milestones. In other words, I'll take, for instance, here, Pine Street. It's an environmental remedy. You have two parts here listed underneath it. Everything below that is relative to accomplishing what's being asked in part 1 and 2, part A and part B.
Yes, that's correct. The exception is Marshall Road, where that's performed under the Property Transfer Act. So that's Mr. Burgess can speak to that a little bit more than that. That is, well, Bill, if you want to answer that.
Yeah, that's under the lead of a licensed environmental professional. So it's not, I wouldn't say a DEP directive, but the licensed environmental professional is approving the investigation and the remediation of the site and sending those reports to DEP.
Okay. So, okay, thank you. That's my question. Final area. And not to belabor the point on deferrals, but the only deferral that the company is seeking in this rate application is, first of all, what's been accumulated for Chapel Street. And then any excess or shortage from the base amount going forward. Is that a correct statement for any environmental remediation site?
I think when you first asked the question, the word environmental might have been missing. That is the only environmental deferral we.
Environmental, I'm sorry, I didn't mean deferrals in total.
I think that was a fair characterization. Otherwise.
Okay. Just one more question. Are there any other environmental remediation expenses captured anywhere else within the application, outside services, schedule, any other particular line item, or are they all captured right here?
I think I can agree with you. I'm just going to restate that with a little more specificity.
Please.
All of SCG's environmental costs are reflected on Schedule SCG WP C 3.04 lines 7 through 10.
Thank you.
I think I may have omitted the word remediation in that sentence, but that's where they're all located. There aren't anywhere else.
Thank you. Okay, that's all I have.
Okay, thank you. Attorney Wright? Thank you. EOE? Thank you, Commissioner. I have no questions. Would you like a moment to consider redirect? Okay, it is 3 o'clock. Do we want to take 10 minutes and double it up with our afternoon break? All right, so we'll resume at 3:10. All right, any redirect?
No, we have no redirect for this panel.
Okay, great. Then thank you. This panel is excused and we can pull up our supplemental panel, please.
Yes,
And
thank you. So this will be Mr. Langland and Mr. Romero, who were in the testimony relates to the gas operations panel that they both appeared on.
right, I'm sorry, let me locate Attorney Wheel. I think we're like technically a minute early, so I'll let everybody. I'll just give him a second. It's still not technically 3:10, so I can't give him a hard time. Okay, then Attorney Venor, if you can pick up what you're saying.
Yes, thank you very much. We appreciate the flexibility. So, Mr. Langland, do you recall during yesterday afternoon's testimony as part of the gas operations panel, Attorney Wheel asked you some questions regarding LFE 68 and attachment, and the attachments to that document.
I do.
And those attachments are the unregistered meter reports, correct?
That's correct.
And do you have some clarifications relating to the testimony you provided yesterday?
I do, and I appreciate the opportunity to provide that clarity for the record. There is a nuance to that report provided in 068, 075 that could lead one to conclude that unregistered meters have gone unnoticed or unaddressed by the company for many years. An example of that would be if you had John Doe move out of his house in 2015, and then he has electronic ignition, he has no pilots, he doesn't use gas. And then Jane Doe moves in 2024 and starts to use gas, that report would indicate the gas usage actually occurred since 2015, 9 years, which is not the case. So really, when you look at that report, you need to focus on usage and not on the dates, because we picked this up just recently that you could look at this report and say, the company has meters out there spinning or, showing usage for many, many years. And that's not what we intended to indicate with the report.
Okay, thank you. And that would apply, though that information would apply equally to the reports provided, the SCG versions in LFE 75, correct?
That's correct.
Okay, thank you. Thank you. That's the clarification we wanted to provide.
Okay, thank you. Attorney Wheel, does that prompt any clarifying questions from you, sir?
Yes. I do. I just have a couple of questions. I understand the testimony, but I just want to make sure I understand the column designations. So I found, as you were speaking, I found an instance, I think that looks like the scenario you were discussing. And it's hard because this is a PDF, so it's not numbered, but I'm looking at a portion of the report. It's on page 1 of LFE 68 attachment 1 that, and I don't know if it matters for you to find it because we're just using it as an example. There's one that for the first vacant read date, it says April 16th, 2013. And then for the bill rel MR date, it's January 13th, 2022. So would that be an example of one that looks like there was a period of 9 years where there wasn't any activity, but that doesn't, according to what you just said, that isn't necessarily the case. Is that correct?
Yeah, that would be my understanding. I don't have it in front of me. My computer is actually battery's dead, so I can't look at it. But yeah, that's the exact scenario I'd be describing.
Okay. I just as a follow-up, related to the same topic, I think Mr. Romero, you were explaining to me what that bill, is it the bill related meter read date? Is that what bill?
Yeah, that's the last date that meter received a usage, or recorded a usage. So if it drove around or EAMI picked up on it, that would be the date that would be reflected there.
Okay. So to kind of put that into context, again, I'm looking at the same line, but actually maybe to make it easier, if you have a document open, I can just look at the first line just so that everyone's looking at the same numbers, even though the
Yeah,
first.
I have 068 attachment 28, which happens to be, I think, the last.
Oh, attachment 28. Okay.
Right. It's just,
I was looking at.
it just happens to be the one that I have open from our last conversation. I think that's the.
Sure.
That's the April 2024.
That's the, thank you. That's the April 2024.
I had attachment 1 open, so just a second, I just want to make sure we're looking at the same thing. One, and now I've lost that. Can you remind me what the late file exhibit number is?
It's
Wait. 068.
068.
I was on 168, sorry. And you're on attachment 28, which is April 2024.
Correct.
Okay. So the very first line, just so that we can all be looking at the same thing, shows that what I assume it stands for bill related meter read date of April 11th, 2024. So that's the date of last recorded usage, right?
Correct.
Okay. And the first vacant read date on that first line is October 13th, 2015. So I take Mr. Langland's testimony to mean that despite the gap in those dates, it doesn't necessarily mean that there was active usage between those dates. Am I understanding that correctly?
Consistent usage throughout that time frame, correct.
Okay. So hypothetically, that meter could have although the first vacant read date was in October of 2015, that meter might not have been used until April 1st, 2024. And still, it still would have looked like that. I mean, it probably would have had slightly different, lower usage readings on this report, but it's possible that there could be. Am I understanding that concept correctly?
You are understanding it perfectly. And there could also be actions taken between that time frame. So we could have gone to that location, shut off that meter. We could, and the tenant could have then done something about it to start using again. We could have then locked the meter, and then the tenant could have broken the lock and continued to use. So there's possibilities past beyond, that scenario.
Okay.
But it's not consistent usage.
Understood. And I just want to make sure I fully understand all three of these dates. The last billing date was the date that the last bill was issued to the last customer account that was associated with the meter. Is that correct?
I believe that to be correct.
And then what's the first, I think you answered this before, but just make sure I understand, the first vacant read date, what's the reason that there would be a read after the last bill?
It was when the customer closed their account. So that's the starting point for the usage trigger.
Okay, so after a customer closes out their account, there's one last read and that sort of gets recorded on the book so the company knows what the meter was at when the account was closed.
Continue. Yeah, correct.
Okay. Thank you. I have no further questions.
Thank you. Any clarifying questions?
Oh, no.
Okay. Thank you. Does the company have anything further?
No, we don't. Thank you.
Thank you. Then thank you to the supplemental panel, and we can move to
Thank you.
final CNG panel on rate design and cost of service. I believe EOE is up first for cross-examination, please.
Okay.
Okay, Attorney Venor, are there any new witnesses?
No, all of these witnesses appeared previously as part of the rates panel and are all sworn.
Okay,
So,
thank you. Any late file exhibits to adopt?
yes, thank you. All right, to the panel, I'll ask all these questions to each of you and just have you respond. So do you oh, sorry. As part of your preparation for this hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the docket?
Yes.
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 And do you have any corrections or changes to any of your late filed exhibit responses that were not previously identified in a response to a late filed exhibit?
No.
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 And with that, do you adopt your late filed exhibit responses as part of your sworn testimony in this case?
Yes.
Yes.
Yes. Okay, thank you very much. With that, the panel is available for cross.
Thank you. Attorney White or Mr. Parent?
Good afternoon, panel. Chris Parent from EOE again. Nice to see you all again. Knowing that we're the last panel before the end, I promise we're not taking our full amount of time. The only real topic that I wanted to get to discuss was really to obtain some clarification. So I'll refer you to LFE 197. And then I'll also be referring to the attachment 1.
We have that.
Great, thank you. The company's response suggested that it would not oppose a usage cap, but the response also suggested that a seasonal cap would be better. The response referenced examples of 120, and that's for CNG, CCF for the winter months and 30 CCF for the non-winter. Assuming that a seasonal cap was implemented, are these the averages that the company would suggest be used?
It's not an average, it's a cap. So for each month, there would be either 120 or 30. And it's based on our review of the build frequency data that we included in each of the detailed tabs.
Thank you for that. So would these be what the caps are that you would recommend? The 120 CCF for the winter months and the 30 CCF for the summer months? I wasn't sure if it was an example or if it's what the company was recommending.
I think they're just examples. We didn't do the exact math. I think what you'd want to do is take the winter usage and average, come up with for each month of the winter, what the winter could be, and then what the summer or non-winter months could be. So I wouldn't say it's exactly what we would recommend, but it's an example of the kind of differentiation you would try to achieve between a winter and a non-winter seasons.
Okay, so does the company have a suggestion for the winter months? It appears as though the 30 for the summer was consistent for both companies. I'm imagining that was the recommendation. Perhaps I'm wrong. I guess that's the question.
No, it was just, again, just an example.
Okay, so what would the company recommend for the 2 seasons?
So if we were to look at the bill frequency for a winter month, for example, January, we would probably recommend somewhere between bill frequencies between 70 and 80%, which would be usage between 130 to 150 roughly. So somewhere in that range. We would have to, pick what we thought was most representative or most reasonable for a winter month.
So somewhere between 130 and 150. So my second question is, I was trying to understand the dynamic spreadsheet that was provided. If I use the 130 that you just referenced, specifically in LFE 197 attachment 1.
Right.
And well, I guess let me clarify this. So that's for the winter months. Would the summer months be 30?
I think we would agree that 30 is a reasonable number for the summer.
Okay. So my last real question is, I just want to make sure that I understand how to use the spreadsheet that was provided. It's a very interesting spreadsheet, very slick. Whoever created it, it appears very sophisticated. Haven't followed through all the logic yet, but it was interesting to start to look into it. If I plug in 130 for the months of December through April and 30 CCF for the remaining months, I just want to make sure that I understand what is being generated and if I can use the spreadsheet to generate that. So plugging in that information into LFE 97, am I correct to understand that the reduction under that scenario would be 4,978,441? And the total cost would be the 17,847,419.
If I may slow you down, I just want to make sure that we had the same months. So you had 30 for which months?
If I understood the response, May through November would have the 30. And if I misunderstood, just please correct me as to what months you would apply the 30 for.
Well, let's go with May through November for purposes of tying out the numbers that you had.
Sure.
So doing that, and we're just essentially inputting those values for each month on line 6 in the spreadsheet.
Yep.
Yep. I think you got to shift F9. Okay, there it goes. Okay, we have the results now. So if you want to,
please,
I'll read them, or you can. I couldn't remember what you said. I apologize.
So I'm just trying to understand if I'm interpreting the spreadsheet correctly. Based on my input of those numbers, I end up with a reduction of 4,978,441.
Correct.
And the total cost, just to make sure I understand what the total cost would be under this program, would be 17,847,419.
That's uncapped.
Okay.
So you need to go to column I for the capped, line 18, and it's 12,868,978. So the difference between those two numbers is the reduction to the total discount because of the cap.
Correct. Actually, I think I was saying that. Maybe I wasn't clear. So if there was no discount, it would be the 17,847,419. If there was no cap, apologies. Apparently I'm tongue-tied at the end here. So if there was no cap, it's the 17.8. The cap reduces that by roughly 4.9 million.
Correct.
And I'm interpreting the spreadsheet correctly.
Absolutely. That's correct.
I'm going to end up the same concept for SCG. I think you did. I'm all set. Thank you.
Thank you.
We're all set, but if the SCG panel's next, we weren't sure if we.
Oh, okay. Got it. Got it. Thank you. Attorney staff, authority staff have questions. Attorney Wheel. Yes.
Good afternoon, Tom Wheel for the Office of Consumer Counsel. Sorry, I seem to have misplaced my name tag, but I thought we'd probably all rather not spend the time looking for it. I think I just have two questions. The first is on LFE 195. And it's really just a clarification question. I assume it's for Mr. Therian, but I'll wait until you're there.
I have that.
So just for, I think this is what the response says, but is the analysis in OCC 679 attachment 1 what this LFE was looking for, which was the application of the LiDAR to the application attachment that was asked about?
Yes.
Thank you. That was my one question on that. My only other question is on LFE 194.
Okay, I think we have it. I think Ms. Pillell is the witness on that response. So I think depending on the question, we'll have her come up.
Sure. So the question is, Consumer Counsel Coleman actually was asking some cross during the hearing that led to this late file exhibit. And as I recall, what Consumer Counsel Coleman was getting at was her questioning was about whether and to the extent that there is a difference between the reconnection fee that's assessed to customers versus the costs incurred by the company in reconnecting customers. And I think what we had hoped to see was the information we have here, but also the costs incurred for reconnections during the test year. I see that the late file, but the request says fees incurred during the test year, and I imagine the company interpreted that to mean fees charged to customers during the test year. But does the company have a breakout of the actual costs the company incurs in reconnecting customers?
So my understanding is the fee is based on the time and labor that it takes to do the activity. So I believe that this would be representative of the cost to the company for accomplishing the reconnection.
Okay. Thank you. And I think we talked about this during the hearing, but as this late file exhibit shows, there's a range for, like, so for instance, residential customers are assessed a reconnection fee, it looks like ranging from $121.57 up to $456. All right, so is that variation driven by customers, the fees that customers are assessed are based on like a hours of time, or is there a variable factor that drives that?
It's time based, and the minimum is 90, so that would be the lowest. And then that's the median of this range. There's an data that goes along with this, then it indicates all the inputs. And then there's a maximum, and my understanding of some of those maximums, the reason why they're high is that it's circumstances where customers, we had to go back multiple times, like they perhaps, if they weren't home for the reconnection fee, they're charged, the time that it takes for the technician to go to the house and then to go back. Or if they were supposed to fulfill some obligation before we turn them back on and we went to turn them back on and they hadn't done it, then they get a repeat visit. So those are some of the ones that are higher, but it tends to, start at $90 for a basic reconnection charge.
Okay, thank you. So my understanding based on that is that in 2022, the most any residential customer happened to be charged in that year was $456 because of the hours, the $90 plus the hours incurred in finally reconnecting. Is that
Yes.
accurate? Okay.
Yes.
Thank you. That's our last question for this panel.
Thank you. Attorney Wright?
No questions.
I have no questions. Do you need to consider a redirect?
I think just briefly.
Okay.
Yeah, thank you. We have just one question on redirect.
Okay.
Make sure people are ready. All right. Mr. Marini, you recall cross-examination from the EOE that asked you about the winter period for purposes of a potential cap on the low income rate.
I do.
And do you have some further comment you want to offer on that?
I do. In the example that was posed, we were asked about which months would be winter and provide a cap of 130 CCF versus summer, which would provide a cap or a one, yeah, I think we said 130 to 150, but in the example, we used 130 on the spreadsheet in a summer usage cap of 30. We modeled the winter as December through April in that example, and the summer as May through November. We'd recommend November be included in the winter months, not as a summer month. So the cap in the November, so we define the winter as November through April 30th.
Okay. Okay, thank you. With that clarification, that's all we have.
Thank you. We transition into our final panel, SCG, and EOE is up first. Attorney Menora, please.
Thank you. We have all the same witnesses. And to the panel, do you recall answering a series of questions I asked you at the start of your testimony for CNG on this topic?
Yes.
And do you also recall answering questions on cross-examination during the CNG portion of the hearing?
Yes.
Yes.
And in appearing now for SCG and for purposes of administrative efficiency, do you adopt your testimony from the CNG transcript and stipulate that if asked those same questions again, your answers would be the same?
Yes.
Yes.
Thank you. With that, the panel is available for cross.
Thank you. Mr. Parent.
Thank you, panel. Again, Chris Parent from EOE. Am I correct to understand that the form and function of the spreadsheet provided for SCG in LFE 207 would be the same?
That's correct.
And thank you for the clarification on the month of November in your response. Am I to assume that would also apply for your response to SCG?
Yes.
The responses for SCG actually had a different example of usage cap for the winter months. I guess my sole question is what would the company propose the caps to be for SCG? Specifically for the winter months versus the summer months, with the November being added to the winter months?
For the summer, we'd recommend the same as we did for CNG, which I think was 30.
Summer 30, okay.
Right. In the winter, it would be a little lower. I mean, the bill frequencies are showing a little lower usage between the 70 and 80%. So you could go a little lower.
What would the company recommend based on what you're observing for the winter months?
I mean, for administrative ease, we could stick with 130. It's roughly at the 75% range. So I think that would be reasonable.
Great. Thank you. That's all we have.
Cory staff? No. Attorney Wheel.
Hello again, Tom Wheel for the Office of Consumer Counsel. I had asked Mr. Therian a single question about LFE 195, the SCG equivalent to that is LFE 205. Is there any reason that the response to that single question would be different for SCG?
They are the same answer.
Thank you. And Ms. Palella, sorry, or any member of the panel, I suppose, could answer this. I had asked some questions regarding LFE 203 about reconnection fees. Sorry, LFE 194, and the SCG equivalent of that is LFE 204. Is there any reason that the responses to those questions would be different for SCG? Well, with respect to SCG.
The only difference the only difference would be the minimum is 125 for SCG, but the reasons that Ms. Palella gave for the costs are the same.
Thank you. No further questions.
Thank you. Attorney Wright. Thank you.
No questions. No.
I have no questions. Do you need to consider redirect?
No, we're all set. Thank you.
Thank you. Brings us to the end of our hearing agenda. As discussed this morning, we will hold the evidentiary record open until 4 p.m. on Wednesday, May 29th for the sole purpose of supplementing the record with the supplements requested over the last 2 days. Is there anything further before we adjourn?
Just related to that, Chair Gillette, just for clarity too, the company has 4 discovery responses that it was asked to update with like evidence as of the close of the record. These were all from the cost of capital panel, and they are RRU 541, 544, 550, and 552. So those were requested in the questions themselves. So we're preparing updates, and those would be the only other items that we submit as supplements.
Understood. Thank you. And so the data would be current as of 5/29 if it's available.
I think we get as close as we can to still file on 5/29.
Okay.
So it's probably, it will be within several days of that.
Okay, that's helpful. If it can, I'm sure you would do this anyway, but if you could just clarify what date.
It will state that specifically.
Okay, thank you. Anything further from any party or intervener? All right, if not, thank you very much. We are adjourned and tomorrow's hearing is canceled. Thank you. You all right? Yeah. Okay.